bank for only what happened now? So Industrial Development Bank of India initially aimed at industrial development. Now they're running as a universal bank, the commercial bank activities. Then Small Scale Industry Development Bank of India, SIDBI, focus on financing and developing the micro and small and medium enterprise sectors. They are focused on micro and medium, small, focus on financing and developing the micro and small and medium enterprises sectors. That is the main motto of SME. SIDBI role by India. That's they are lending money to the micro loan and small and medium sized company. They were lending money to the development of our small and medium sized companies. This is the all India development financial institutions. Then followed by we discuss on state level financial institution. You can expect question from state level financial institution also. State level financial institution, particularly they established by individual states. All individual states established by state level financial institution. This corporation primarily financed small and medium enterprise within the jurisdiction. That's very, very important. Within the state level, they're lending money to the small and medium sized companies. For that purpose, they started a state level financial corporation. This question also you can expect from your examination. The main objectives of state level financial corporation established by individual states. This corporation primarily finance small and medium enterprise within the state, within the jurisdiction. Then state level industrial development corporation, that we called as SIDCO, that is called as State Industrial Development Corporation. So state level industrial corporation to promote growth within the specific states by providing financial assistance and developing industrial infrastructures. That's very, very important. So all these financial institutions, what is the main aim of, main objectives and main goal and main destinies of this all financial institution? To lending loan to the infrastructure development, agricultural development, SME development. So same as to they follow by state level financial institution also. They also to promote industrial structure, infrastructure structure and agriculture structures, particularly within the state level, SME people to get benefit from this loan. And otherwise the domestics, state level GDP were increases based on this SAP contribution to the state level. For that purpose, the lending loan to the SME within the state level. So they promote industrial growth within specific states by providing financial assistance and developing industrial infrastructures. Then specialized financial institutions. Specialized financial institution means specifically for export-import purpose, agriculture purpose, housing purpose, and life insurance purpose. Life insurance coming under general insurance followed by life insurance. For other purpose, they started specialized financial institution. So specialized financial institution, the main institution is Exim Bank. Export-import purpose. Facilitate India international trade by providing finance for import and export. That is very, very important. Facilitate India international trade by providing finance for import and export. This question also can expect from your examination. Particularly, the government of India proposed financial institution for Exim Bank, export-import purpose, international trade purpose. They were running the bank in India. That is the main objectives of Exim Bank. Facilitate India international trade by providing finance for export and import. Then other bank is National Bank for Agricultural and Rural Development, NABARD. National Bank for Agricultural and Rural Development, NABARD. NABARD focus on promoting rural development and providing credit support to agricultural and rural activities. That's very, very important. So NABARD setting the microfinance institution in 1980. NABARD were setting the 1986. NABARD were setting the microfinance institutions, particularly development of rural and urban area. The main aim is NABARD is to promote the agricultural sector in the India, to promote agricultural sector in India and particularly rural area. They can support, they can lending loan to rural people to doing for accessing the financial service for credit service for micro credit service for agricultural development. That is the main aim of NABARD Bank for Agriculture and Rural Development focuses on promoting rural development and providing credit support to agriculture and rural activities. Then Housing and Urban Development Corporation, HUDCO, Housing and Urban Development Corporation, support housing and urban infrastructure project, particularly within domestic level, not last level, domestic level, support housing and urban infrastructure project, because infrastructure is very, very important. Infrastructure development is very, very important. Any country to become a economically strong nations, any economy are very, very, very good economy. If we take any example, America or followed by China, UK, German, Japan, Australia, followed by many countries were showing their infrastructure. That is very, very important. Infrastructure development to show your economic strength to outside economy, to outside countries. So infrastructure development is much, much needed because we need logistic management, supply chain management to reach the end users, transportations, airways, waterways, and roadways, and followed by pipeline ways, and followed by all other ways. Infrastructure is very, very important to reach the destinies. Who is our end user? Customer is our end users. For that purpose, Housing and Urban Development Corporation to support housing and urban infrastructure project, either government project or private projects. They're lending money to housing, they're lending money to their providing loan to infrastructure project. That is the main aim of Housing and Urban Development Corporation. This question also you can expect from examination. There's a 7 question we discuss. All India Development Banks. First one is IFCI, Industrial Financial Corporation of India. Next one, Industrial Development Bank of India. Industrial Financial Corporation of India, they support industrial project with long-term loans. Then Industrial Development Bank of India, initially aimed as an industrial development bank, then now as a commercial bank. Then Small Industry Development Bank of India focuses on financing and developing micro and small and medium enterprises sectors, particularly for SME people to benefit from these SIDBs. Then followed by state level financial institution. So state level financial institution benefit from the state level people, state level business people, state level agriculture sector people, state level SME people, state level infrastructure people. For that purpose, they started State Financial Corporation, then State Industrial Development Corporation, SIDCO. SIDCO is within the state. They develop the industrial sector. Within the state, they develop the industrial sector. For that purpose, they're lending loan to the small scale industry, like Pondicherry people were running their business in Tatanjali industrial estate and followed by other real industrial estates. The concentration on they're getting loan from State Industrial Development Corporation of Puducherry and followed by Tamil Nadu, SIDCO, Tamil Nadu. Many area where Kadalur, if you go for Kadalur and followed by many areas, they have in the separate area to start a small business. For that purpose, they're developing the rural economy. That is the main aim of that state Industrial Development Corporation, developing the rural economy, to develop the rural employment opportunities, and to develop the per capita income of our rural and standard of living. This is all coming under water. State Industrial Development Corporation main objectives. Then specialized financial institution we discussed, that is called as Export Import Bank of India, Exim Bank, for export import purpose in international level, across the boundaries, across the border. Throughout the global, you can link together. That's the export import. The country where more and more export, the country have good economy. The country have less and less export and more import means the economy is a poor economy. So Exim Bank play a vital role for export and import purpose. They have given guidance and technical support to the exporter and importer. They are giving the guidance and also they create awareness among the export and import program they conducted, how to do the export and import activities, how to do a marketing throughout the global to a product. All this process done by Exim Banks, because people does not aware of the export and export because they have good product They already reached the domestic level. They have an excess of customer, but how to promote that product in the global level? They don't have awareness. So Exim Bank create awareness program among the exporter and importer to develop the economy and to attract the foreign reserves. That is the main aim of export and import banks. The National Bank for Agricultural and Rural Development. I don't want to discuss this because only for agricultural purpose, development of rural purpose, development of rural purpose and development of agricultural purpose. They started National Bank of Agriculture and Rural Development. Then housing and urban development for urban infrastructure. Housing infrastructure is very, very important. For that purpose, they started Housing and Urban Development Corporation of India. Then investment institution, investment. People are ready to invest their money. They're ready to take the risk. Yesterday we discussed on money market instrument and followed by capital market instrument. Money market coming under short-term investment and the capital market coming under long-term investment. For that purpose, they stated financial institution. They started investment institution on behalf of the customer. The investment institution invest money. Taking risk on behalf of the customer, they will take the risk and invest the money like a portfolio manager, like a fund manager, like a other investment manager. They were working on behalf of the investors. That's why they started investment institution, unit trust of India, UTI, one of the primary investment institution offering mutual fund services. Yesterday also we discussed, they offer mutual fund services because people doesn't have investment avenue. People doesn't have aware of investment avenues. Many investments are available in India. People doesn't know how to invest, where to invest, when to invest. They don't have aware of that investment. They always preferred fixed deposit. They always preferred post office deposit. This is the main mobilizing money from the public for financial institution, fixed deposit and post office deposit. But other than other investment avenues available in India, like capital market, money market instrument, and followed by real estate, and followed by gold, and other than gold, mutual fund companies collecting or mobilizing money from the public. They are lending loan to the corporate people. They are lending loan to the venture capital, new business people. They identify the good people doing new business. They are lending loan to the new business people. And also they invest money on behalf of the investor. They invest in different sector, and give more interest rate, more return on investment, more return on asset, value of asset. They are giving to the customer. They are giving interest to the customer. That is called as investment institution. Then life insurance corporation. Many people know life insurance corporation. They provide insurance services while also investing in development project. They're mobilizing money from the public in terms of insurance, life insurance, in terms of general insurance. Not only their compensation purpose, they were running the business. They are also investing money in different projects. Government of India depend on LIC and GIC. Life Insurance Corporation of India and General Insurance Corporation of India depend on for many projects, railway project, air project, water project, road project, pipeline project, for infrastructure project, and many projects they depend on Life Insurance Corporation, General Insurance Corporation. They provide insurance services while also investing in development project. So each DFI play a specific role targeting different segment of the economy. Each development financial institution play a specific role in targeting different segment of the economy and collectively fostering economic stability, infrastructure development, and social progress across India. That is very, very, very important. Social progress across India. What is mean social progress? All people getting benefit from this development. That is a democratic finance. All people having money, equal money. The excess of money, 1% of people richer, remaining 99% of belongs to poor, still is maintaining. 1% of people occupying 70% of asset in India, remaining 30% the middle class people. This was happened in India. If you want to democratic to all, the finance is a democratic to all. That is called as democratic finance. That is a social progress equal to all. social progress in this across India. In what way you to implement social progress across India? You can equal to all. So job, basically job, you can provide job opportunity to all and increase their standard of living and increase their per capita per income. For that purpose, development financial institution specifically targeting different sector, different segment of the economy, collectively fostering the economic stability, They increase the economic stability and infrastructure development and social progress across India. Social progress across India. That is the mean by third unit. So third unit is completed. You can expect any questions from this third unit. First question is. Um, um, First question is Industrial Finance Corporation of India. Second question is Industrial Development Bank of India. Third question is Small Industry Development Bank of India. Then fourth question is State Level Financial Institution Corporation. Then fifth question is State Industrial Development Corporation. Then seventh question is Export Import Bank of India. Then eighth question, National Bank for Agriculture and Rural Development, NABARD. Then Housing and Urban Development Corporation of India. Then Unit Trust of India, Life Insurance Corporation, and General Insurance Corporation. You can expect 5 marks as well as 10 marks from this third unit. Then we move on to fourth unit now. This is the fourth unit. To understand the component of Indian financial system, to review the performance of Indian financial system, to understand the role of financial intermediary is the objectives of fourth unit. They will cover Indian financial systems, and second one is in financial market, primary market and secondary market. Then primary market including a listing regulation, mutual fund and physical system, mutual funds and the Indian physical system. You can expect question from fourth unit, Indian financial systems, Indian financial systems, and followed by financial market. What you can expect? Primary market and secondary market, primary market and a secondary market. Then followed by listing, how to list the company. Yesterday we discussed on listing, no, equity shares. Once you issue in equity shares, after only you can listing in the listed in the stock exchanges, NSE or BSE. Stock exchanges coming into NSE is coming under 50 companies listed in stock NSEs, and 30 companies were listed in the Bombay Stock Exchanges, National Stock Exchange and the Bombay Stock Exchange. How to listed that company? What are the regulation followed by listing in company in stock exchanges? Then followed by mutual fund. Just now we discussed mutual fund. Mutual fund, Unit Trust of India, where open mutual fund company in India, 1970 stage. Then Indian physical system. Indian physical system will discuss. You can draw this diagram. Indian financial system. Indian financial system divided into three categories. One is financial assets. We already discussed financial assets. Instrument like a treasury bill, equity share, preference share, bond, debentures, and deferred share. That's called an instrument. Then, money market instrument we discussed: call money, notice money, treasury bill, certificate of deposits, repo purchase agreement. Many discussion we discussed on financial asset instrument, then followed financial market. What are the market we are running in India? Forex market, exchanging the foreign currencies. That is called as forex market. Capital market. Capital market means you know that selling and buying for shares. That is called as capital market. Then money market. Money market also to buy what? Call money, notice money, and followed by treasury bills issued by RBI, Reserve Bank of India. State level institution also issuing bond. Central government also issuing bond. Municipal government also issuing bond. Any autonomous body also issued bond to the public, mobilize money for their development for short-term crisis. That is called as money market. Then credit market, lending loan to the corporate people. Already we discussed credit market, lending loan to the corporate people, lending loan to the corporate people. That capital market, money market coming under two market: primary market and secondary market. Primary market and secondary market. Primary market means you are the first time to buy the equity share. That is called as primary market. First time you are a new customer, new investors, or new company, we want to buy the share, equity share, preference shares, bond, or anything. You are the new. That's a company also be new, or existing company issuing new share to the public. New company issuing to the share to the public, or existing company where issuing a new share to the public. That is called as primary market. You are buying that share for the first time. That is called as primary market. The same share were traded 1 day, 2 day, the share were traded in the secondary market. The same market, stock market, you can buy anytime, buy and sell the share. That is called as secondary market. You don't want to newly buy the share or newly sell the share. You can open market. That's the open market. Anytime you can go buy the share and sell the share. That is called a secondary market. But primary market is totally different. You are the first time to buy the share, equity share. That is called as primary market. That is called as primary market. Secondary market means the same share were traded in the stock market. Anytime you can go buy and sell the share. That is called as secondary market. Then physical asset instrument divided into three categories. That's a money market instrument, capital market instrument, then hybrid instrument. Money market instrument, capital market instrument, and a hybrid instrument. Already we discussed what is money market instrument, capital market instrument, followed by hybrid instrument. Financial market, they divide into money markets. That's a short-term funds, and capital markets for long-term funds. This market facilitate the movement of funds among various sectors of the economy. These markets facilitate the movement of funds among the various sectors of the economy. Primary market deal with the new issues, while the secondary market provide a trading platform for existing securities. Primary market deals with the new issues, with the secondary market providing a trading platform for existing securities. Then financial instrument. These are the various securities or products available in financial markets, including equity, debt, and hybrid instrument. Including equity and debt and hybrid instrument. Equity means they are issuing share to the public. Debt instrument means bond. They are issuing bond to the public. Anytime they after the period is over, you can settle the amount to the investor along with the interest rate, along with the capital amount. That is a debt amount, borrowed amount. That's we called as loan, like loan. That's a borrowed amount. Why? That's why we called as debt amount, equity, and a hybrid instrument. Hybrid instrument, call option, put option in derivatives were called as hybrid instrument. Future, forward, this contract were happen in hybrid instrument. These all the instruments were available in the financial market. These all instruments available in the financial market. They provide investment avenues. Already I told, they provide investment avenues and raise capital with the support of intermediaries. Raise the capital with the support of financial intermediaries. Because all the corporate companies having experience in issuing share, but they need help for bank. That's why we go for financial intermediary, merchant banking, consultant, underwriters, fund manager, portfolio manager. We called as any name. Stock broker, we called as any name. That's why we go for intermediary. So they raise the fund from the public. corporate or government raise fund from the public for any project. So with the help of intermediary, support with the help of intermediary, they are issuing share to the public. With the intermediary mobilize money to the public and settle the amount to the corporate. They deal with what? Customer and as well as corporate for commission rate. So investor trust intermediaries and corporate also trust intermediaries. So legally they are running the business. Bank were running the business. That is called as, this includes both banking and non-banking financial entities. Include these intermediaries. Intermediaries work. It includes both banking and non-banking financial entities. Banks, insurance companies also were including this process. Then pension funds and mutual funds play a crucial role for ensuring efficient allocation and utilization of fund across the economy. That's very, very important. That's very, very important. That includes both banking and non-banking financial entities. Banks, insurance companies, pension funds, and mutual funds play a crucial role in ensuring efficient allocation and utilization of fund across the economy for different sector, different corporate, different business people, government project. They're mobilizing fund from the public. They're involving that mobilized fund from the public. Who are involving mobilizing fund from the public, fundraising from the public. Banks, including non-banking entities and insurance companies, pension fund companies, and mutual funds play a crucial role. This is a financial system in India. Structures of Indian financial system in India. Indian financial system consists of financial market and financial instrument and financial intermediaries. So financial market divided into two categories. That's a money market for short-term funds, capital market for long-term funds. This market facilitates movement of funds among the various sectors of the economy. The primary market deals with new issues, while secondary market provides a trading platform for existing securities. Then financial instrument. These are the various securities of products available in the financial market, including equity, debt, and hybrid. The mixture of borrowed amount, mixture of debt, mixture of financial instrument, equity shares, and debt amount, bond, debentures, preference shares, then followed by hybrid instrument like call option, put option. We go for future and forward coming under hybrid instrument, or currency trading. This all coming under derivative market. This is called coming under hybrid instrument. These are all coming under hybrid instrument. Who are all intermediaries of this for fundraising from the public? Banks, non-banking financial entities, insurance companies, pension fund, and mutual funds are intermediate role played by the mobilizing from the public, fundraising from the public for utilization, allocation of across the economy. This is called as financial institutions, Indian financial system. This question you can expect from your 4th unit. What is primary market? Already discussed what is primary market. They're issuing new share to the public. That is called as primary market. Money market also, that is money market is for short-term purpose. Capital market for long-term purpose. They're issuing new share to the public and also existing the new shares. After that, they're getting platform to trade that share in the NSE or BSE. That is existing market. That is called a secondary market. You can go buy and sell the shares anytime. That is called a secondary market. Then money market instrument. Already we discussed money market instrument. Call and notice money, treasury bill, term money, certificate of deposit, commercial papers. So call money means for 1 day is called as call money for 1 day period. For short period, for 1 day period. Then 1 to 14 days period is called as notice money. Treasury bill issued by RBI, 90 days, 180 days, 270 days, and 360 days, which is 1 year. Then term money issued by bank, and then certificate of deposit issued by bank. They borrow money from the public. Then commercial papers issued by corporates. They are so commercial paper issued by corporate. They also need money for short-term purpose. Hybrid market instrument, I told, very foreign exchange market. Foreign exchange market. Foreign forex, we are deal with foreign currencies. We are deal with foreign currencies. And also hybrid instrument have both futures, equity and debentures. This kind of instrument is called as hybrid instrument. Example, convertible debentures. Anytime you can convert preference share into equity share. Then financing form of capital market. These are the two companies can raise money from the financial market, namely debt and equity. Debt and equity. Two form of fundraising from the public. One is bond. You can repay money and along with interest rate. Capital amount along with interest rate. That is called bond market. Debt market. Debt market. Borrowed market or a lending market. But my equity market is fundraising from the public. You can equity shares. You can accept loss and profit from the equity shares equal to all. You have all rights to elect your chairman. You have all right to elect your chairman. Once you are issuing the equity share, then only you can list it in the stock market. That is called as IPO, initial public offer. Initial public offer. So these are all the progress coming under hybrid market instrument. Hybrid market and instrument equal, both mixture of component, both mixture of product, debt and equity. Then we call as foreign direct investment, FII. We two types of people were there in investment in India through foreign exchange. Through foreign exchange, one is FDI, foreign direct investment. Exemption of all the taxes for FDI people. Exemption of all the taxes because they come over India to do a business to benefit of domestic people. They're waiting for long-term period to cultivate the profit. We are attracting FDI people to do a business in India, exemption of all the taxes. Exemption of all the taxes. Any undeveloped area in India, any underdeveloped area in India, so government of India allowed to do a business in underdeveloped area because government of India to concentrate on underdeveloped area to invest money to develop the area. It's quite difficult. For that purpose, they are allowing foreign people to do a business in that area on the exemption of all the taxes, to develop the rural economy, to create a new employment opportunity to the domestic people, and also increasing the domestic business. When FDI people tap the business from domestic level, create a market, create a competitive market among this local, among the state level, among the national level. They allow the FDI people to enter into India to do a business, and also we attract foreign reserves. That is very, very important. Foreign reserves, and also they utilize all these our resources, natural resources, for doing business in India. Doing business in India. And the FII, other people is other ways to attract the foreign currencies. That is FII. Foreign institutional investors. Foreign institutional investor. How Indian domestic people or Indian national people were invested money in India, Indian stock market. The same way we allow the foreign people participating in Indian stock market. That is called as foreign institution investment. That way also you attract foreign currencies. That is called as foreign exchange market. This is called as FDI and FII. Financial intermediary. You are all coming under financial intermediary. Stock exchange. Intermediary stock exchange market is capital market. Secondary market to securities. Investment bankers. Investment bankers also called as intermediary. Capital market and credit market. Corporate advisory service and issue of security. Already told. Bank and followed by other financial institutions. Bank and non-banking NBFCs, insurance companies, mutual fund companies, and other financial institutions were issuing the security to the public, and also they are giving advice to the corporate people. That's why we called as role played by the investment bankers, corporate advisory service, and the issue of securities. Then underwriter. capital market and money market. Capital market and money market. Portion of securities, underwriters. They are promoting the securities on behalf of the corporate. Promoting the security on behalf of the corporate. And portion of the security they hold, selling to the public, mobilizing money from the public. There's an underwriter, capital market and money market. Then registrar, depositor and custodian. In capital market, they are more involved in capital market. Registrar, depositor and custodian. Who is a custodian of that money? Who is protect the investors' money? So that's why called as registrar and depositor, custodian. The issuing security to the investor on behalf of the companies and handle the share transfer activity. Already we discussed. The issuer, they are issuing security to the investor on behalf of the companies, on behalf of the corporates, and also handle the transfer activity, mobilizing all the money from the public and transfer money to the corporate. That is, they were registrar, depositor, and custodian. They are working. Then primary dealer and satellite dealers, money market. Money market is government securities, market making government securities. So already we discussed money market. So all the government institution issuing, mobilizing money from the public. That's why called as money market. Who are the primary dealers or satellite dealers for money market is government securities. Then forex dealers, forex market. Ensure exchanging in foreign currency coming under forex dealer. These are the dealers coming under intermediate role played by financial institution. What is primary market? You can expect this question from your examination. IPO and FPO. IPO means initial public offer. So initial public offer means initially the company want to start a business and listed in the stock market. So they need help for merchant bankers, intermediary help. Like we called as underwriter. With the help of underwriter, they are issuing IPO to the public. Before that, many processes were happened. Initial public offer. They're collecting they're collecting all history of the company, product of the company, profit and loss of the company. Totally all the prospects they're collecting from the company. They issue to the public. Then all the documents issued to the public, where all the documents show to the SEBI, Stock Exchange Board of India. All the document file is over. Then move to, they are collecting, issuing share to the public, and also set the money for 10 rupees share or 12 rupees share or 15 rupees share. They are slab set by the merchant bankers. Finally, the stock investors were quoted the money 12 rupees or 13 rupees or 15 rupees. Finally, the money will fixed by merchant bankers sitting along with the corporate people. Then also they are collecting all the money state-wise, all the region-wise, they collecting money and divide the share to the public, divide share to the every investors, 10 share, 20 shares. All this process done by merchant bankers. Finally, they sit to corporate people and decide everything. And finally, they are issuing share to the public and also collecting money from the public, and also 12 rupees share or 15 rupees share they are allocating, means the remaining rupees also settled to the shareholders. Then finally, all the process will be over. They were listing in, because they issue the new share to the public. They are buying the equity share. Finally, all the process will be over. They are listing in the stock exchanges. NSE, that is called as IPO, initial public offer to the investors. We called as equity shares. That will be dealing in primary market, not secondary market. Dealing in primary market, that to capital market. You see the issues. Issue to the public, initial public offering, fresh issue, offer for sale. That's why we called as what? Primary market. Fresh issues, new issues, public, initial public offering, fresh issue, offer for sale. They're ready for sale, that shares, equity shares. Then public, FOP, that further public offering, fresh issue, offer for sale, that is called as FOP. So rights and preferential share were there. Rights and preferential share will be there. You know that preferential share also issued to the public. The preferential share product is totally different from equity shares. Preference shares, they can issue to the public, new company issue to the public. Public doesn't know about the company performance, past performance and present performance. Public doesn't know about the product of the company, past history of the company, balance sheet of the company, product of the company, customs of the company. So they are, before going for equity share, because equity share you can accept and loss. The company make more profit, is enjoying the profit. Company fall down means the company make loss, means you can accept loss also. That's why we go for equity shares. You can accept profit and loss. You can high risk, high return, high risk, high return. Trade off between risk and return coming under equity shares. The same on preference shares. Trade off between risk and return. But preferential share is whatever it may be happen for the company. Company making profit or loss. We don't bother about anything. The customer, the company first settle the amount to the preference shareholders. That is called as preference shares. The interest rate along with the capital amount. Suppose the company performed well after the month, the preference shareholders, anytime they have option, they have facility, the company were facilitating to the preference shareholders, anytime they converted into equity share. This option is available in preference shares. This is called as issues. The following figures showing the public, initial public offer and FPO, further public offering, same, fresh issue and offer for sale, Then listing regulation, we already discussed listing regulation. Application of respect new issues, offer for sale and book building process. Application respect of new issues, offer for sale and book building process. These are the process. You can expect the question from book building process. Book building process, already told very clearly. You can collect all the information from the company and all the information to collect the company, and they settle all the information about the company and create a brochure of that company to selling to the shareholders for seeing that company details, and also the same all the details, company balance sheet and all the document should be registered under SEBI Stock Exchange Board of India. And after later you can selling the share to the public, collecting, mobilizing money from the public. Who are done this process? Merchant bankers. Merchant bankers done this process on behalf of customer and corporate. They're getting commission from both people, and also they're collecting money and the different state, region, and the collective money, and fix that money, allocate the share to the investors, 100 shares, 10 share, 20 share, allocation of share to the for the share, sitting along with the corporate people. They decide how many share were allocated for every person. And also the slab money, 15 rupees, they are allocating money, but finally they choose 12 rupees or 10 rupees per share. So remaining money settled to the investors. So all the process will be over. They ready to issuing the share to the public. That is called as initial public offering. Later they listed in the stock market, stock exchanges. All this process will be over. They listed in the stock exchanges. That is called as underwriting. You can expect that question also coming from your examination. Then mutual funds. Mutual funds coming under fund manager. This question also you can expect from more examination. What is a mutual fund? Investors. You see that flow of diagram. Investors pull their money from fund managers. Investors pull or mobilizing money from the fund manager. Fund managers mobilizing money from the public. Then they were on behalf of the investor. All the monies were invested in different securities. Then generate returns. Again, they pass back onto investor. That's called as mutual funds. They were working on behalf of the investors. They work like a fund manager. They work like a portfolio managers. Within 100 rupees, they're collecting 100 rupees from the mobilizing money from the investor. The 100 rupees, they were allocating the money in different sector. One is purchasing 20 rupees for, 30 rupees for equity share, 20 rupees for bond, 10 rupees for fixed deposit, 10 rupees for post office deposit, and 10 rupees for gold, 10 rupees for real estate, 10 rupees for insurance company. All the share were, all the different securities where they invested. One security is not performed well, other security were performed well, because they don't want to lose the capital amount. So they want to make profit. And portfolio investment, they follow portfolio investment, diversify the risk. They are not risk taking from the one securities. All the pressure not put it on the one securities, one instrument. So many investment avenues are available in this globe. They are investing in different securities. The risk will be diversified, risk will be reduced, because the trade-off between risk and return. And finally, they are taking more returns and back to the investor. That is called as mutual funds. That is called as mutual fund. Then next class we'll see by 15 minutes more. Thank you so much.
Good morning, all of you. Hello. Can you hear me? Good morning, all of you.
Good morning, ma'am.
Very good morning.
Good morning, ma'am.
Very good morning, ma'am. Can you see PPT?
Yes, ma'am.
Okay. Ratio analysis. Yesterday we have seen liquidity ratios, right? Liquidity ratios, that is current ratio, quick ratio or liquid ratio, absolute liquid ratio. Current ratio formula, current assets divided by current liabilities. Current assets, what are they? Stock, debtors, cash in hand, cash at bank, bills receivable. So all these things are current assets. Current liabilities are bills payable, current liabilities, creditors, bank overdraft, outstanding liability. These are all current liabilities, right? So liquid asset, what is the difference between liquid asset and current asset? Only the two items. You have to exclude stock and prepaid expenditure from the current asset, that is called liquid asset. Okay. So liquid liability, if you exclude bank overdraft from current liability, that is called liquid liability. Sometimes current liability you have to apply for liquidity ratio also, because bank overdraft if it is not available, you can take current liabilities itself. Absolute cash reserve cash ratio, that means you have to take only cash in hand, cash at bank and short term marketable securities. That is those assets easily quickly converted into cash, that is absolute liquidity ratios. Okay, these are the formulas. Norms, current ratio 2 is to 1, quick ratio 1 is to 1, absolute liquidity ratio 0.5 is to 1 or 0.75 is to 1. We can take anything. Next one, activity ratios. Activity ratios, that is, it measures the efficiency of the management, how the assets are utilized, how the productivity turnover, how much stock turnover, what is the debtors turnover, what is the creditors turnover. That means what? Turnover means sales. Credits are suppliers. How many times on your sales they are allowing you credit period? How many days or months you are allowing to your uh, debtors? So these are the ratios which are measuring the efficiency of management, right? First one, let us see stock turnover ratio. Stock turnover ratio, you have to take the formula. Cost of stock is always, you have to take the cost of goods sold, right? Cost of goods sold means that is sales minus gross profit. If you are eliminating, that is called cost of goods sold divided by average stock. Stock turnover ratio formula, cost of goods sold divided by average stock. Average stock means opening stock plus closing stock divided by 2, right? Um, Debtors turnover ratio. Debtors turnover ratio, the ratio is credit sales divided by average debtor. So in this case, credit sales only you have to take. Cash sales should not be taken. Only credit sales divided by average debtor, that is opening debtor plus closing debtor. This debtor includes receivable, accounts receivable, bills receivable. All these things comes under this debtor, right? So opening you have to add, that is a debtor plus bills receivable, that is called accounts receivable. So you have to take opening plus closing divided by 2. You can take average. Suppose opening, if it is not given, you have to take only closing debtor. Okay. Similarly, creditors turnover ratio. Creditors turnover ratio, the formula is credit purchases divided by average creditor. So credit purchases, I have to take only the what is the purchases, supplier credit purchases, that you have to take into account, and divided by average creditor, that is opening creditor plus closing creditor. Creditor, which means bills payable and accounts payable. Bills payable and creditor is called accounts payable. You have to take opening and closing average, or if only closing creditors available, you have to take that, right? In this case here also, debtors turnover ratio, after you calculate, you have to calculate what is the average collection period. Average collection period, which means how many days or months will be taken for collecting debt amount from your debtor. The formula is number of days or weeks or months in the year divided by debtor's turnover ratio. So you can find out what is the number of days or number of months once you are collecting your debt from your debtors, right? The next one, creditors turnover ratio is also like that. You have to calculate average payment period. Average payment period formula is number of days or months in the year divided by creditors turnover ratio. Next one, working capital turnover ratio. Working capital means what? What is working capital? Current assets minus current liability is the working capital. So here working capital into turnover. Turnover means sales. So total sales divided by working capital. So working capital, how many times on your sales? That is called working capital turnover ratio, right? The next one, profitability ratio. So profitability ratios, that is gross profit ratio, operating ratio, net profit ratio, return on capital employed, earnings per share. So these are all profitability ratios. Profitability gross profit ratio means which is on sales, right? So net sales, you have to deduct return on sales return or return on sales, right? So net sales minus net sales have to take either you have to take cost of sales. Gross profit, how you calculate? Sales minus cost of sales, that is gross profit. So how much percentage gross profit is covered on your net sales? So net sales divided by gross profit. Operating ratio, that is operating expenditure, cost of goods sold plus operating expenditure you have to take divided by net sales from operation. Net sales, what is given in your problem? So cost of goods sold plus operating expenses. So what is the percentage is covered on your sales, right? So net profit ratio is also you have to calculate net profit divided by net sales into 100, right? Return on capital employed. Return on capital employed means what is the profit you got it after payment of your interest and taxation on your capital. So capital, how much times it is or how much percentage it is covered. So return on capital employed is equal to PB means profit before income tax, right? Before interest and income tax, right? Before interest and taxation, not income. Profit before interest, not income. Interest and taxation, right? So divided by capital employed. So capital employed means what is the capital employed? You have to take either liability side approach or asset side approach you can take. If you take what is the actual total assets minus current liabilities, that is capital employed you can take, or you take fixed assets, that is proprietary fund equity share capital. If you take liability approach, equity share capital and debt capital we have to take, that is called capital employed, right? What is the actual capital you are utilizing to your business to earn the profit or loss. So this ratio reflects the efficiency of the utilization of your investment, right? Then earnings per share. Earnings per share means what is the earnings available to your equity shareholder. So what is the profit earned by the company after payment of your interest on your debt capital, and then preference shareholder, if you have to pay any dividend after deducting payment to everyone, what is the profit available to the equity shareholder divided by number of equity shares. So number of equity shares per share. So that is why you can calculate earnings per share, right? Then next one, long-term solvency ratios. Long-term solvency ratios, what are they? Debt to equity ratio, debt ratio, proprietary ratio, interest coverage ratio. These are all long-term solvency ratios. Debt equity ratio. Debt equity ratio means what is the proportion of debt to capital. Whether is it sufficient to pay for from your equity capital. What is this proportion? That is the debt equity ratio. Debt to capital, the formula is debt divided by, debt means long term debt divided by shareholder fund. Long term debt means debentures, bond, mortgage loan. These are all long term debt. Divided by shareholder fund means equity share capital plus any capital reserve or any resource, pluffing back of your profit if it is there, that you have to take it, right? Next one, debt ratio. Debt ratio, you have to take only what is the long-term debt covered on your capital employed. That means capital employed means net assets. Total assets deduct your current liability, that is called net assets, right? So long-term debt divided by net assets. Capital employed is long-term debt plus if you either you take liability approach or asset side approach. Liability side approach, that is long-term debt and shareholder fund. If you take asset side approach, that is current assets, net assets, you have to deduct non-fictitious assets and current liabilities, right? Non-fictitious means total asset, physical asset. So all assets minus current liability you have to deduct. Next one, proprietary ratio. Proprietary ratio formula, shareholders funds divided by capital employed or shareholders funds net assets, right? So how much shareholders funds are covered on your capital employed? So what is the percentage to calculate? Right. Next one, interest coverage ratio. So interest coverage ratio, the formula is net profit before interest and tax divided by interest on long-term debt. Right. Let us do some problems you can understand. Right. See here. The balance sheet is given. You are required to calculate liquid ratio, debt equity ratio, solvency ratio, stock of working capital ratio. Right? So balance sheet are given. What is the formula for liquid ratio? Liquid asset divided by liquid liability. Liquid asset, here you see what are the current assets. Current asset is stock, debtor and cash. So if you want to take a liquid asset, you have to take only debtor and cash. You have to leave stock, right? Only if you take current asset, current ratio, current asset means stock, debtor, cash you have to take, right? So liquid liability, liquid asset is 2 lakhs plus 1 lakh. So 3 lakhs is the liquid asset. Liquid liability, if you take, see here, creditor and overdraft. So if you are eliminating overdraft, that is the liquid liability. If you are taking overdraft and creditor, that is current liability. So you take only creditor, right? So 2 lakhs. So liquid asset is 3 lakhs divided by 2 lakhs, right? So your liquid ratio is 1.5 times. The next question, what they are asking, debt to equity ratio. Debt to equity, external equity divided by internal equity. That means long term debt divided by shareholders fund, right? So what is the external equity? You can take not only long term but also current liability is also external equity. So see here, 6% debentures 3 lakhs, current liability is 3 lakhs, so total external liability is 6 lakhs. So 6 lakhs divided by internal equity. Internal equity is how much? See, your equity share capital 15 lakhs and reserve fund 1 lakh. So totally 16 lakhs, right? So internal equity is 16 lakhs. External equity is 6 lakhs. So 6 lakhs divided by 16 lakhs, that is 0.375 times. The next one, solvency ratio. Solvency ratio, what is the formula? Outside liabilities or external equities divided by total asset. So outside liabilities, that is debenture. What are they? debenture, overdraft, creditor, these are all external liabilities. External liabilities, both long term as well as short term, right? So that is 6 lakhs divided by total assets. Total assets, is it sufficient to pay for your external liability? That is the meaning, right? So total asset is 22 lakhs. So 22, your external liability is 6 lakhs divided by 22 lakhs into 100. So what is the percentage is covered? 27.27 percentage is covered on your asset. So good solvency. Stock of next one, stock of working capital ratio. So working capital ratio, that is stock divided by working capital. What is working capital? Current asset minus current liability. So current asset total is 8 lakhs minus current liability is 3 lakhs. So working capital is 5 lakhs. So what is your stock? See your problem. Stock, what is given? 5 lakhs. So 5 lakhs divided by 5 lakhs. Stock turnover ratio, 100 percentage. Stock turnover ratio is 100 percentage. That's all. Sometimes this kind of statements, balance sheet or profit and loss account will be given, and you may be required to calculate current ratio, quick ratio, cash reserve ratio, working capital ratio, debt equity ratio. All these things they may ask you. If you know thoroughly the formulas, then only you can apply. And also you should know how to apply. Current asset means what are the items are comes under current assets, that you should know. Otherwise it is difficult to do, right? So you have to by heart the formulas, as well as you have to see the items. What is current asset? What is current liability? What is working capital? What is external equity? What is internal equity? So all these things you should know, right? Let us do this problem. See here. Sometimes ratios will be given in your problem. You have to find out some missing figure. You have to find out what is the value of closing stock. So what is the value of current asset? What is the value of current liability? Like that. Ratios will be given in your problem. So in that case, how to calculate? See this problem. Calculate the amount of current assets and current liability. You have to calculate. Current ratio is given 2.5 times and working capital is 60,000, right? So what is your current ratio formula? Current ratio formula is current assets divided by current liability. So current asset divided by current liability is equal to 2.5 times, right? That means what? If your current liability you have 1 time, your current asset will be 2.5 times. That means your current asset is 2.5 times, your current liability is 1 time, right? Working capital, what is working capital? Current asset minus current liability is the working capital. 60,000 is given. So your current asset is 2.5 times minus current liability is 1 time. So 1.5 times is equal to, that is 60,000. 1.5 times is 60,000. What for? 1 time. So that is current liability. What for 2.5 times? That is current asset. Okay. See here 40,000. 60,000 divided by 1.5, that is 1 time is equal to 40,000. So 40,000 multiplied by 2.5, that is current asset is 1 lakh. Current liability is 40,000. Okay. Then next one, activity ratio. So activity ratio, that is what is given, debtors turnover ratio and average collection period. Debtors turnover ratio, what is given in your problem? Total sales 4 lakhs, cash sales 20% on your total sales. Opening debtor given, closing debtor given. You are required to calculate debtors turnover ratio and average collection period. So what is the formula for debtors turnover ratio? What is the formula? Net credit sales, isn't it? Net credit sales divided by average debtor. Net credit sales, what is given? Total sales is 4 lakhs given. Cash sales is 20%. So you have to take only credit sales. So 80% of 4 lakhs is how much? 3 lakhs 20,000. So 3 lakhs 20,000 divided by Average debtor, opening debtor is 40,000, closing debtor 1,20,000. What is average debtor? 40 plus 120 divided by 2. So 160. 160 means 80,000, right? So what is your debtors turnover ratio? See here, 3,20,000 divided by 80,000, that is 4 times. So debtors turnover ratio is net credit sales divided by average debtor, right? Now we have to calculate average collection period. So what is your average collection period? Number of days or months in the year divided by debtors turnover ratio. What is given in your problem? Days or months, anything is mentioned? If nothing is mentioned, you take 365 days in the year. If you want to say, express in number of days, or if you want to express in number of months, 12 months in the year, right? So 365 days or 12 months divided by 4 times. Debtors turnover ratio is 4 times. So the answer will be, the average collection period will be 91 days or 3 months. 91 days or 3 months. Okay. Next one, calculate creditors turnover ratio. Creditors turnover ratio is also like that. Here you have to find out what is the net credit purchases divided by average creditor. Net credit purchases, see here given in your problem, to 12 lakhs. Creditors plus bills payable, both are, you have to take, that is accounts payable on first 1/1/2005, that is opening creditor 4 lakhs, closing creditor is given 2 lakhs. So average means 4 lakhs plus 2 lakhs divided by 2. So 3 lakhs, right? So net credit purchases 12 lakhs divided by 3 lakhs. 12 by 3, that is creditors turnover ratio is 4 times, right? So what is the average payment period? Average payment period, how many days once or how many months once you are going to pay your creditor. So number of days in the year, that is 365 days, or number of months in the year is 12 months, divided by creditors turnover ratio is 4 times. So 91 days or 3 months, that is the creditor average payment period, right? Similar way, stock turnover ratio. Stock turnover ratio, what is given? Opening stock, closing stock, wages, closing stock, sales are given, wages, sales, purchases, carriage inwards. Why all these informations are given? Because stock turnover ratio, you have to take cost of goods sold, or sales minus gross profit, right? So that you have to take into account, and average inventory divided by average inventory. So net sales or cost of goods sold we need to calculate, because sales is given, gross profit is not given, so we cannot find out. So what is the trading account? If you prepare, left hand side opening stock plus purchases plus other expenditure, credit side sales and closing stock, the difference will be the gross profit, right? So now you take the debit side, 18,000 plus wages 14,000 plus purchases 46,000 and carriage inwards 4,000. These things you add it on side, and credit side, that is 80,000 sales and closing stock 22,000. That means 1,02,000. 1,02,000 minus was minus, either you take like that, or what is your gross profit? 18,000 plus 46,000 plus 14,000 plus 4,000. How much comes? Yes. Make it total and tell me. 50, 68, 78, 82. So 20,000. Your gross profit comes 20,000. Sales is 80,000 minus gross profit 20,000. So cost of goods sold is 60,000. Okay. Your average inventory, opening inventory plus closing inventory divided by 2. That is 18,000 plus 22,000 divided by 2. That is 20,000. So stock turnover ratio is 60,000 divided by, that is cost of goods sold. 60,000 divided by average stock 20,000. So 3 times. Stock turnover ratio is 3 times. See the next one. From the following information, calculate stock turnover ratio. Sales 4 lakhs, gross profit ratio 10% on sales, opening stock, closing stock. Stock turnover ratio, that is net sales or cost of goods sold average divided by average inventory. That is stock turnover ratio. You take cost of goods sold. If it is available, you have to take cost of goods sold. If it is not available, you take net sales, right? So in this problem, sales given and gross profit ratio is also given. You take it. So 4 lakhs minus cost of goods sold is 10 percentage, 40,000. So 3 lakhs 60,000. Your cost of goods sold is 3 lakhs 60,000 divided by average inventory, opening and closing divided by 2. So average inventory is 40,000. So if you take cost of goods sold as base for stock turnover ratio, answer is 9 times. If you are taking net sales is the inventory turnover ratio, that is 10 times. Okay. Mostly cost of goods sold you have to take. If information is not available, you have to take sales. Okay. Similar way, see here that this problem, some data are given, you are required to calculate debtors turnover ratio, creditors turnover ratio, stock turnover ratio, like this. See here, the sales, purchases, opening stock, debtors, bills receivable, everything given. You practice this problem. Okay, let us do some other. In this problem, total assets turnover, calculate total assets turnover and fixed assets turnover, working capital turnover ratios they are asking. The balance sheet are given. So total assets turnover ratio, what is the formula? Net sales divided by total assets. Net sales, what is given here? Sales, what is given? Here, sales for the year 2018, 30 lakhs. So net sales means sales written. If it is given, you have to deduct. Otherwise, you have to take 30 lakhs. So 30 lakhs is the net sales divided by total assets. Total assets, you have to take how much? Total assets. Individually given, you have to take plant and machinery, land and building, motor car, furniture, stock, debtor, bank, cash. Make this total. Make this total. How much comes? How much comes? 4, 13, 15, 16, 17, 18, 19, 70, 20 lakhs, right? So total assets are 20 lakhs. So 30 lakhs divided by 20 lakhs, that is 1.5 times. The next one, fixed assets turnover ratio. Fixed assets turnover ratio, what is the formula? Net sales divided by fixed assets. So fixed assets, you have to take only plant and machinery, land and building, motor car, furniture. That's it. So 14, 13, 15, 16 lakhs, right? So 30 lakhs divided by 16 lakhs, 1.88 times. Working capital turnover ratio, that is net sales is the same. Working capital means current asset minus current liability. Current asset, you have to take only stock, debtor, bank and cash. Stock is so 2 lakhs 90,000, 370, 4 lakhs, right? So current asset is 4 lakhs, current liability is here 10,000 outstanding is there, so totally 2 lakhs. So current working capital is 2 lakhs, right? 4 lakhs minus 2 lakhs. Your net sales is 30 lakhs divided by working capital is 2 lakhs, so 15 times, right? Similar way, you practice this problem. You are required to calculate gross profit ratio, net profit ratio, operating ratio, and operating profit ratio. This is just like that. You have to apply the formula gross profit divided by sales into 100. Net profit that is gross profit means sales minus cost of goods sold is the gross profit. Similar way, net profit ratio, net profit divided by sales into 100. Like that you have to calculate. Okay. Then let us do some problems. Ratios will be given. This kind of problem will be given in case study, 15 marks question, or sometimes 10 marks questions also they may ask you in part B or part C. Small problem if they have given, they may, even part A also they might be given, like only small 2 items, 3 items given, calculate current liability, current asset, like that. So if it is given lengthy one, it may given for 10 marks or 20, 15 marks case study, right? So let us do some problems, ratios to balance sheet. Okay. See this problem. Um, you are required, informations are given for 31/3/2018. You are required to prepare balance sheet. Only for few items are given, but you have to find out the items value and you have to prepare balance sheet. Working capital, what are the informations are available? Working capital 2,40,000, bank overdraft 40,000, fixed assets to proprietary fund ratio 0.75 times, resource and surplus 1,60,000, current ratio 2.5 times, liquid ratio 1.5 times. With only these are the informations are available, right? So with this information you are required to calculate what is current asset, what is current liability, what is stock value, what is cash value, what is the fixed asset value, what is the share capital value, and then what is the reserves and surplus. So all these things you have to calculate and you have to prepare balance sheet. That is the your question, right? So with this available information, how we can derive the values from one from another, right? You have to calculate. There is a clue, working capital is the clue, current ratio is given, right? So what is current ratio? Formula current asset divided by current liability, right? Working capital means what? Current asset minus current liability. So current asset, current ratio 2.5 times are given. That means if your current asset you have 2.5 times, you are able to pay for your current liability one time of your current liability. So 2.5 minus 1 time is equal to working capital 2,40,000, right? So 2,40,000 is for 1.5 time. What for 1 time or what for 2.5 time? That is the current asset you can derive, current liabilities also you can derive. So 2,40,000 divided by 1.5 into 2.5, that is current asset, 1,60,000, that is 2,40,000 divided by 1.5, how much? 1.5 is, if you are calculating, 16 lakhs, right? So multiply by 2.5 times, that is 4 lakhs, not 16 lakhs, 1,60,000. If you multiply by 2.5 times, that is 4 lakhs is the current asset. So your current liability is 1 time, that is 1,60,000. So your current liability is 1,60,000. Current asset is 4 lakhs. Current liability is 1,60,000. Out of this, liquid ratio also given. So liquid ratio, what is the difference between current asset, current ratio and liquid ratio? Only stock, right? So let us assume stock is the difference. Stock is how much? 1 time, right? So your current asset that is 4 lakhs. Stock we do not know, that is divided by current liabilities. Liquid liability is also, let us assume current liability is taken, not a liquid liability taken, right? So 1,60,000. So 1.5, if you are taking stock outside, 1.5 into 1,60,000 is equal to, that is 4 lakhs, right? Equation, if you solve it, your stock value is 1,60,000. Okay. The next one, see your problem. With the available information, we have calculated current asset, current liability, and then stock value also we have calculated. But there is no other clue how to calculate. See here, fixed asset to proprietary fund ratio. Either if you know fixed asset, we can find out proprietary fund, or proprietary fund, if we know, we can calculate fixed asset. Both the thing we do not know. So what we can do, we have to apply liabilities. That is a formula for equation, accounting equation. Accounting, what is accounting equation? That is assets are equal to your liabilities and capital, right? So that is the equation. See here, your balance sheet equation, that is shareholders fund fixed assets, or this side, left hand side, if you take shareholders fund plus current liability, if you take liability side, fixed assets plus current assets. Let us assume there is no long term liability, there is no other long term liability, right? Debentures we do not have, we are assuming that, right? So fixed assets to proprietary ratio, it is given 0.75. That means what? If you have one time of your proprietary fund means what? Capital, equity capital plus resource and surplus. That is called proprietary fund, right? So proprietary fund, if you have one time, your fixed assets will be 0.75 times. So let us assume fixed shareholders fund or proprietary fund, let us take 1x, okay, one time 1x plus current liability we have calculated, that is 1,60,000 already we have calculated, is equal to fixed assets we do not know, that is 0.75x. If you have 1 rupee of your shareholders fund, fixed assets will be 0.75x. So your current asset we know 4 lakhs. Now we have to solve this equation. So if you bring 0.75x this side, and 1x minus 0.75x is equal to 4 lakhs. If you bring 1,60,000 this side, become minus. So 4 lakhs minus 1,60,000, that is 2,40,000. Okay. If you take 2,40,000 divided by 0.25 x, what is x? X value is 9,60,000. That means shareholders fund. Shareholders fund value is 9,60,000. So what is fixed assets value? 0.75 x. X is 9,60,000. So 9,60,000 into 0.75 x, that is 7,20,000. Now, right? So now the shareholders fund, you have, see your problem. What is capital? Resource and surplus is given 1,60,000. Shareholder fund means what? Capital plus resource and surplus, that is called shareholders fund. So 9,60,000, if you eliminate resource and surplus 1,60,000, so equity share capital will be 8 lakhs. Totally it is 9,60,000 we have got it. 1,60,000 is resource and surplus. That means capital, shareholders equity capital is 8 lakhs, right? So now we have got all the informations. Now we have to prepare balance sheet. Come to the liability side, shareholders fund, that is share capital 8 lakhs, resource and surplus 1,60,000. So total shareholder fund is 9,60,000. Under the heading of current liability, in your problem, some clue is given, that is bank overdraft 40,000 is given. Current liability we have calculated 1,60,000. Out of that current liability, it includes the overdraft, right? So 40,000 overdraft minus 1,60,000, that is 1,20,000 you have to write other current liability. So total current liability will be 1,60,000. So here fixed assets we have calculated already 7,20,000. Current assets, that is stock, we have calculated 1,60,000, and the other current asset is 2,40,000. So total current asset is 4 lakhs. So now you have to make the total, both the side, liability side and asset side, you have to give the same total. Then only what you have calculated, that is correct. Okay. To understand this equations given, you have to find out the values of the balance sheet item and you have to prepare balance sheet. Okay. Do you have any doubt in this?
No, ma'am. Excuse me, ma'am.
Yes, ma'am.
Ma'am, can you share all the PPT so that we can practice all the sums?
Okay, ma'am, I will share you. You send mail to me. I will share.
Okay, ma'am. Thank you.
You mentioned your third semester management accounting PPT is required, like that you mentioned. I will send you. Okay. Can we do some more similar problem? Or if you want, you have any question paper, can do that. Okay, let us see this problem. Then if we have time, I will take some question paper, previous question paper problem we will do. Right? See here. Paid up capital 50,000, plant and machinery 1,25,000, total sales 5 lakhs, gross profit of 25%, annual credit sales 80% of net sales, current ratio 2 times, inventory turnover ratio 4 times, fixed assets turnover 2 times, sales returns 20% of sales, average collection period 73 days, bank credit to trade credit 2 times, cash to inventory 1:15, total debt to current liabilities, that is 3 times. These are the informations are given. You are required to prepare balance sheet, right? So there are with this information they have to derive one by one, right? So what is given? Net sales are given. See here, sales, total sales 5 lakh given, sales returns paid up capital, plant and machinery, total sales, gross profit, annual credit sales is 80% of your net sales. Sales return is given 20% of sales, right? So total sales is 5 lakhs. We have to eliminate return, sales return. So 20% on your 5 lakhs is how much? 1 lakh. So sales return is 1 lakh. So now you can find out net sales is 4 lakhs. Out of that, 80% is annual credit sales. Remaining 20% is cash sales, right? So 80% of sales, that is 3,20,000 is the credit sales, net credit sales, right? Uh, Here gross profit is given 25%. So you have to calculate gross profit on total sales. That means net credits, net sales, not only credit but also cash also you have to find out gross profit. So 4 lakhs into 25% your gross profit, that is 1 lakh. So what is your cost of goods sold? Sales minus gross profit, that is cost of goods sold. Cost of goods sold is 3 lakhs you have calculated here. So formula is cost of goods sold divided by inventory turnover. So inventory turnover ratio is given, see here, inventory turnover ratio 4 times are given. So inventory turnover, you can find out inventory. So 3 lakhs is cost of goods sold divided by inventory turnover ratio is 4 times. So therefore stock value is, average stock value is 75,000. Similar way, receivables turnover ratios. Receivable turnover ratio, what is given? Average collection period 73 days are given. So you can find out debtors turnover ratio. So 365 divided by 73 days is answer is given. So 73 days, how many? What is your debtors turnover ratio? 5 times, right? Similar way. How to calculate debtors turnover? Credit sales, we know what is the formula. Credit sales divided by receivables turnover, receivables average receivables, that is net credit sales, we know 3 lakhs 20,000, we know 3 lakhs 20,000 divided by debtors turnover ratio, answer is given. So we can find out average debtor, right? So 3 lakhs 20,000 divided by 5 times, average debtor is 64,000, right? Then similar way, inventory turnover we have found out. Okay. Inventory we know, right? Cash to inventory. So cash, what is given? Cash, we do not know. 1 is to 15 times. Inventory, we know, already calculated 75,000. So 75,000, that is 15 times. Answer is cash to inventory is 15 times. So 75,000 divided by 15, that is cash is 5,000, right? The next, current, total current assets. Total current asset, that is inventory, we know 75,000 average inventory, plus receivables 64,000, cash we know. So total current asset is 1,44,000. Similar way, total current liability, current assets divided by, that is current asset is 1,44,000 divided by 2, that is average, no? Inventory is also average, and then receivable is also average. Here cash is not average, no? Cash to this one. Current liability, see here, current ratio 2 times are given. Current ratio 2 times. So current asset divided by current liability is equal to 2 times. So current asset 1,44,000. Answer is given 2 times. So current liability will be 72,000. Okay. Similar way, bank credit 2-3 times of your current liability. Current liability we have calculated, that is 72,000. 2-3, that is 2 by 3 times, that is 48,000. Similar way, trade credit. Trade credit is half of your bank credit or 1/3 of your current liability, right? So next one, total debt. Total debt is current liabilities into 3 times. See here, answer here is given. Total debt to current liabilities 3 times. So total debt, current liabilities we know. So current liabilities is 72,000 into 3 times. So total debt is 2,16,000. So long term debt is current liability. Total debt minus current liability is the long term debt. 2,16,000 is the total debt divided by, sorry, minus current liability is 72,000. So long term debt is 1,44,000. Similar way, fixed assets. Fixed assets, how to calculate? See here, fixed assets ratio. Fixed assets turnover ratio 2 times. Turnover means sales, right? Turnover 2 times are given. sales we have already calculated 4 lakhs. So 4 lakhs fixed assets turnover means 4 lakhs divided by sorry, fixed assets we do not know. Sales is 4 lakhs. Answer is 2 times. So if you are calculating this equation, you can find out what is the fixed asset is 2 lakhs. Okay. Similar way, other fixed assets. Other fixed assets, that is fixed assets minus plant and machinery, 2 lakhs minus 1 lakh 25,000, that is 75,000. Total assets, that is fixed assets plus current assets, that is 2 lakhs plus 1 lakh 44,000, 3 lakhs 44,000. Net worth, total assets minus total debt, that is total asset is we have calculated here 3 lakhs 44,000 fixed asset plus current asset, right? Total debt is, net worth means what? Shareholders fund or capital proprietary fund. So total asset minus total debt, if you are deducting, that is the net worth or shareholders fund or paid up capital. See here, net worth paid up capital is given in your problem 50,000. So reserves and surplus you can find out. Net worth means 1,28,000, paid up capital 50,000. That means reserves and surplus is 78,000. So you have to calculate like this one by one all the informations, and then now we have to prepare balance sheet. So see here, balance sheet, paid up capital 50,000, reserves and surplus 78,000, total shareholders fund or proprietary fund. If you take this total, okay, 1,28,000. Long term debt is 1,44,000. Bank credit 48,000. Trade credit 24,000 we have calculated. Plant and machinery, if you take a total of this, that is total current liability. Current liability is 72,000, right? So 48 plus 24, 72,000, right? Fixed assets, plant and machinery 1,25,000. Other fixed assets 75,000. Inventory we have calculated 75,000. Receivables 64,000. Cash 5,000. So if you take total current asset is these three items, right? So total balance sheet is 3,44,000. You understand this? There are various problems, many problems are there. Some problems, some informations will be given, some problems, some clue will be given. With that clue, with that information, you have to calculate one by one what is the informations are available. It you can make only by practice. You have to practice many problems, then only you can understand how, what are the informations available, how to derive from one value from another value, right? That is the very important aspect, right? Do you have any doubt? You go through this. If you have any doubt, let us discuss. Next hour is also my hour. I will start funds from operation and funds flow statement and cash flow statement. Let us take 5 minutes break. You go through that. If you have any doubt, you can ask me. Let us after we will continue after 5 minutes. Okay.
Ma'am, please share your email ID, ma'am.
I do not know how to share here, ma. You send mail to me.
Okay, ma'am.
I write my mail ID. This is my mail
No.
ID. You send it to me. I will share it. Okay.
Okay, ma'am. No, I do not know your mail ID, ma'am.
I am sending this.
Okay.
WhatsApp. See here.
1 second, ma'am.
In chat box, I have given. You send it
Okay,
to me. Mention management accounting PPT. I will send you.
okay, ma'am. Thank you.
Okay. Okay, let us start fund flow and cash flow analysis. What is fund flow analysis? Fund flow means what? What is fund? In this case, generally fund means money which we are utilizing for investment, or any other things, right? So here we used to this fund refers to working capital. So working capital means what is the fund flow, inflow and outflow. What is the sources of fund comes to your business, how it has come. Investment, that is capital in the form of equity capital, in the form of debt capital, in the form of sale of your assets. These are all the sources of your fund, how you are getting your fund for your business, right? That is fund. What is the outflow, how we are utilizing that fund in your business, how much it is going outflow every year. So if you are purchasing any plant and machinery, fund will go out, right? So fund means not a cash, it is a working capital. Fund here refers to working capital. So what is the funds flow, changes in your working capital? Flow of fund, inflow and outflow, the difference is called changes in working capital. 1 year balance sheet, if you compare with the 1 year balance sheet with the another year balance sheet, you will find out what is the changes in working capital, is whether is it increase in working capital or decrease in working capital. Right? So why we have to find out this changes in working capital? Why? Because it is very very essential for every business concern. If working capital is if you are keeping idling, to if your working capital is more liquid than what is required. Say for an example, your working capital you are having in your business 10 lakhs, but actually it is required only 6 lakhs. So 4 lakhs is idle, you are not utilizing, keep it in as cash or in any asset form, right? So in that case, that liquid asset will not generate any interest or generate any profit, right? So you have to lose your profitability. Instead, if your working capital is insufficient, say for an example, it is 6 lakhs are required, but you are keeping it in your business is 3 lakhs, so it is insufficient. So insufficient working capital may cause financial risk. That means you are not able to pay for your creditor, and then not able to pay for your debt capital return. You cannot repay your debt capital, right? So in that case, so you have to, your financial risk is involved. So automatically sometimes company may go for liquidation also, right? So you should be very careful. So you have to trade between both profitability and liquidity. That is the importance of fund flow statement. You have to know what is the changes of working capital, right? See here, meaning everything is given. What is working capital? Sorry, fund flow statement. It is a statement of sources and applications of fund. Is a technical device designed to analyze the changes in the financial conditions of a business enterprise between two balance sheet dates. So between two balance sheet date, what is the sources and applications of fund? Right? So the working capital and fund flow indicates flow of working capital between 2 points of time. It involves information relating to the various transformations undergone by working capital. That is, changes that have been placed in working capital during the period involved between two periods of time. So every change in working capital is associated with a flow, either inflow or outflow. So that fund flow involves information relating to the inflows and outflows that resulted in a change in working capital between the 2 points of time. So see here, in this case, you have to prepare. These are the statements. So what are the statements you have to prepare? Statement of sources and applications of fund, or fund flow statement. Everything is one and the same. These are all another names, right? But you have to prepare fund flow statement and schedule of changes in working capital. Two statements you have to prepare. This is movement of fund, inflow of fund, outflow of fund. What are the inflow of fund means? Sources of fund. How you are getting fund from for your business. That is issue of share capital, issue of debentures, bank loan, raising bank loan, sale of fixed assets, and then operating profit. These are all inflow of fund. Outflow of fund is repayment of your preference share capital, repayment of your debentures, repayment of your loan, and then purchase of fixed assets, purchase of investment, payment of taxation. So these are all outflow of fund. So what are the managerial uses of fund flow statement? I have already explained. You go through this once, okay? Limitations also. What is a difference? Let us see finally after studying the cash flow statement, then only you can compare the between the fund flow and cash flow. Cash flow is different, okay? In fund flow statement, how you have to prepare, what are the statements you have to prepare? That is two statements. One is fund flow statement, another one is changes in working capital, schedule of changes in working capital. And then you have to prepare adjusted profit and loss account, and then you have to prepare separate ledger accounts for finding what is the opening balance of purchases of machinery during the year, or depreciation of the during the year, all these things, right? Then one more important thing is that provision for taxation and proposed dividend, non-divider dividend. Provision for taxation and proposed dividend, these two items you can treat either current item or non-current item. What is current item? What is non-current item? Means what? Current item means current assets and current liabilities are current items. Non-current items is fixed assets and then long-term loan, capital. These are all non-current items, right? So this provision for taxation and proposed dividend, you may treat either current item or non-current item. Why this item only we can say either current or non-current? Because if you are treating it as every year we are earning profit, so once earning profit you have to declare dividend to your shareholder. So if you are declaring dividend, you have to pay for them, right? And then every year you have to pay taxation. So once you are paying dividend and paying taxation, you can treat as a current item. Sometimes what you do, you will declare it is not essential to paid out, right? So you may hold it on your reserves and surplus, retained earnings, right? So that in that case, sometimes reserves you are keep it for future purposes. So that is why we may treat it as a non-current item also, right? So you can either treat it, you can treat either current item or you can treat non-current. Taxation is also no need to what is current year you are allotting, no need to pay everything. So this year you are allotting for provision. You're making provision for payment of taxation 5 lakhs, but actual taxation you have paid current year only 2 lakhs. So 3 lakhs you are keeping as a provision in your balance sheet. So that's why you may treat it as a non-current, right? Let us do both. This is the fund flow statement. Sources of fund, applications of fund. Sources, see here, same thing. Equity share capital, issue of preference shares, debentures, all these items, right? Another statement I told schedule of changes in working capital or statement of working capital. Schedule of changes in working capital, that is current assets, cash on hand, cash at banks, data, bills receivable, all current assets, and then you have to take all current liability. Current asset minus current liability, that is working capital. To balance sheet date you have to take. If your current asset increase, the impact of or effect of working capital will also increase. Current asset decrease, your effect of working capital will also decrease. When you go for current liability, reverse. When your current liability increase, your working capital decrease. When your current liability decrease, your working capital increase. That is reverse you have to take while preparing this statement. See here, the effect of working capital. When your current asset increase, working capital will also increase. Current asset decrease, working capital will decrease. Current liability increase, working capital will decrease. Current liability decrease, working capital increase. Okay. This thing you have to keep it in your mind while preparing schedule of changes in working capital. Then next statement you have to prepare to find out what is the funds from operation. For finding funds from operation, you have to do some adjusted profit and loss account. Why we have to do adjusted profit and loss account? Why? Because trading profit and loss account, we are preparing all the other non-trading expenditure and non-trading income also we are adding, and then non-cash expenditure also we are involving. What is non-cash expenditure? That is debentures, and then transferring to general reserve, and then goodwill written off. All these things are non-cash expenditure. And then non-trading income, if you are getting interest on deposit, and then interest on any commission received, rent received. So these are all income other than your business, right? Income generated from other businesses. So we have to adjust this non-cash expenditure and the non-trading income, that you have to adjust it. You have to find out what is the fund generated from your business, what is the funds operated from your business, right? That is called funds from operation. That is why the adjusted profit and loss account you have to prepare. First you have to bring the opening profit and loss account balance sheet. If it is given opening balance and closing balance, opening balance you have to start with this and add all non-current, non-fund items, non-cash items. You have to write it credit side, debit side, all non-cash and non-trading expenditure you have to write it. Then closing adjusted profit and loss account you have to write it. Then find out payment of what is the funds from operation, right? Let us do one problem, you will understand. These are all the accounting treatments, journal entries. See this problem. The following are the summarizers of balance sheet, Bharat Vijay Limited. The following additional informations are given. Net profit for the year 40,000 for charging depreciation. During the year, depreciation charged was rupees 30,000 on building and 40,000 on machinery. The company purchased during the year buildings worth rupees 1,60,000. Dividend paid during the year amounted to rupees 20,000. See here, from the above information, prepare a statement of sources and applications of fund. You are required to prepare only state. You have to see your problem. What is question? What is the question asked in your question, right? Whether you are required to prepare statement of sources and application, means only you have to prepare that one. If they are asking you to prepare schedule of changes in working capital, you have to prepare only current item. This sources and application statement, you have to take only non-current items, right? That you have to be very careful, right? Hello. See here, I have prepared both the statement for your understanding. First one problem. This is schedule of changes in working capital. You have to take only the current items. Fund flow statement, you have to take only non-current items, right? So let us take only current items. Stock, data, prepaid expenses. These three are current item. Building machinery are non-current item. Here, creditors and bank overdraft are current item. Provision for taxation, you may treat current or non-current. If you are treating it as a current, you have to take it in the schedule of change in working capital. You should not touch anywhere else. Or if you are treating it as a non-current item, you should not take in the schedule of change in working capital, but it will take place in the adjusted profit and loss account as well as fund flow statement when you are treating this provision for taxation as a non-current item. I will teach you in both the treatment how you will get it, right? See here, schedule of change in working capital 2002 2003, increase in working capital, decrease in working capital. Current asset, stock, current year, previous year is 90,000, current year is 80,000, 10,000 reduced than the previous year. So 10,000 impact is decrease. right? Debt are 1 lakh 40, 2 lakh 40, so impact is increased. So prepaid expenses 15,000, 25,000, 10,000 increased. So total current asset. Current liabilities are creditors 70,000, 80,000, right? So 10,000 increased. So current liability increased means impact is decreasing working capital. Bank overdraft is same, no impact. So next, now you make the total of current liability. Here provision for taxation not taken. That means we are assuming this one as taken as non-current item, right? If you are treating as a non-current item, now you have to write it here, provision for taxation 30,000, 40,000. So 30,000, 40,000, 10,000 increased. That means you have to put it in the decrease column. So in that case, you will get here 30,000 will come in decrease column, increase column 1 lakh 10,000. Here increase in working capital 1 lakh 10,000 minus 20,000, 90,000, right? So this is increase in working capital. If you are treating it as a provision for taxation here 10,000, so 80,000 will be the increase in working capital, right? Now let us prepare fund flow statement. Before preparing fund flow statement, let us find out funds from operation. For that, we have to prepare adjusted profit and loss account. See here, this is adjusted profit and loss account. Uh, Profit and loss account balance, opening balance and closing balance. See your problem. Profit and loss account 40,000 opening balance previous year, current year 60,000. So profit and loss account we have to prepare. See here, by opening balance 40,000, closing balance is 30,000, sorry 60,000, right? Closing balance. Now what are the information, non-cash items, what are the things are given in your problem that you have to see. Depreciation is the non-cash item. Depreciation is given in your adjustment. Depreciation charged during the year 30,000 on building, 40,000 on machinery. So depreciation you have to write it in the adjusted profit and loss account debit side, and also you have to take it in the machinery account credit side, right? Dividend paid during the year 20,000. So dividend paid also you have to write in the adjusted profit and loss account, because you are paying from your profit, right? So depreciation on building 30,000, machinery 40,000, dividend paid 20,000. Then provision for taxation, here we are treating it as a non-current item. So you see your adjustment, provision for taxation, tax paid during the year or tax made during the year. What is anything is given in your adjustment, according to that you have to prepare, right? If in this problem taxation nothing is mentioned, so if nothing is mentioned, what you have to think of, previous year taxation, provision for taxation, you have to treat it as payment for during this year, previous year, that is opening. See here, provision for taxation ledger account. This is a liability, that's why opening balance you have to bring the credit side. By balance, opening balance is 30,000, closing balance you have to write in the debit side, right? Previous year balance, opening balance, you have to treat it as a tax paid during the year. So to cash, tax paid. Current year provision is made during the year. Made means you have to allot from current profit, from profit and loss account. So by adjusted profit and loss account, this 40,000 made, you have to take it in the adjusted profit and loss account here. This paid 30,000, you have to take it in the outflow of fund flow statement. See here, fund flow statement, applications of fund side, you have to write tax paid during the year 30,000. Sometimes in your adjustment problem itself, in the adjustment will be given tax paid this much or tax made this much. Anyone, if it is given, you have to prepare this provision for taxation account, ledger account. Then you have to find out, if paid is given, you have to write it here, find out what is made. If made is given, what is paid, you have to find out. Nothing is given, previous year you have to treat it as paid, current year you have to treat it as made. Okay, then You close this adjusted profit and loss account, you can find out the difference between the debit side exceeds your credit side, that is funds from operation 1,50,000. Suppose your credit side exceeds your debit side, that is funds lost in operation. Debit side, if you get balancing figure, that is funds lost in operation. So funds from operation, you have to write it in the sources side of fund flow statement. So fund flow statement, sources side, you have to write funds from operation. What you have find out, that you have to write it here. Then non-current items come to the balance sheet. Share capital 3 lakhs, 4 lakhs. That means what? Issue of equity share capital. Sources of fund, inflow of fund. So inflow of fund, you have to write it in the profit fund flow, sources of fund flow side, debit side, right? So see here 1 lakh. And then debenture 2 lakhs, 2 lakhs 50,000. That means 50,000 you have raised issue of debenture during this year. You have to write in the sources side of fund flow statement. These things are you should not take into account because these are all already we have taken in current items, right? Only the provision for taxation paid you have to write in the fund flow statement. Here tax paid 30,000 you have to write it. Then buildings 1,20,000, 2,50,000. You have to prepare ledger account of building. Why? Because building or machinery. Depreciation is there. See here, depreciation on building 30,000 is depreciation on building. So 1,20,000 minus 30,000 depreciation. How much should be the value of this year? 90,000 only, right? 120 minus 30, 90,000 should be shown. But 2,50,000 is showing. That means what? You have purchased buildings during this year, right? Similar way, machinery 3 lakhs minus 40,000 is depreciation. So it should shown value 1 lakh 2 lakhs 60,000. So 2 lakhs 60,000 only. So machinery there is no purchases. See here, building purchases is given 1 lakh 60,000. See here, let us prepare ledger account, building account. To opening balance 1,20,000, closing balance 2,50,000. By depreciation on building 30,000. But bank purchases, if it is not given in the problem also, it is balancing figure. You have to find out this 1,60,000 purchases. So purchases of building you have to write in the application side of fund flow, right? Or outflow of fund. Purchases of building you have to write it here. And then dividend paid, whatever given in your adjustment, 2 places you have to write it. Dividend paid, one is you have to write in the user side, application side, and then adjusted profit and loss account, debit side you have to write. Similar way, provision for taxation paid you have to write it in the application side, made you have to write it in the adjusted profit and loss account. You have to keep it in your mind, all these things, right? Now you have to close your fund flow statement. So you have written, now you check your balance sheet, all the items you have taken, non-current items you have taken, then adjustments also you have taken into account. So now you have to close this fund flow statement. Debit liability side 3 lakhs. This side is 90,000 is your answer. Increase in working capital, right? Your sources are greater than your uses, that is source increase in working capital. Suppose your applications are greater than your sources, that is decrease in working capital. So see here this statement, schedule of changes in working capital, also you will get the same answer. Otherwise you have made some mistakes. You will get whether you are taking preparation of schedule of changes in working capital or fund flow statement, you will get the same answer. Okay, do you understand this fund flow statement?
Hello. It is clear, Darshini? Yeah, this is
Do you understand, ma? Any doubt? Anybody else? For preparation of fund flow statement?
Management with us. The document you have uploaded, it is not at all clear. We are not able to see anything on that, neither your name nor marks, nothing. So can you please forward a copy of your all your documents?
Do you have any
Scanned
doubt?
copy
Can we go for
to
next question?
Yes.
Somebody is there listening?
E-help
Ah,
desk.
yes, ma'am. You can go, ma'am.
Okay.
It is there in the website.
Next problem, you see, schedule of both the question they are asking, schedule of changes in
Scanned
working
copy of all
capital
your documents
and
to the
statement of
mail
sources
ID.
and
E-help
applications of fund, right?
Huh?
During the year, taxation and interim dividend 35,000 and 39,000 respectively. The assets of the another company were purchased 60,000 payable in fully paid up equity shares of the company. The assets consisted of stock 21,640, plant 18,360, and remaining amount was for goodwill. That means what? Takeover of one company purchased the another company. For that, they have to pay what we can say. For purchases value, right? Purchases value they have to pay. They are paying 60,000 in the form of asset 21,000. They have taken over assets and liabilities will be taken over by that company, right? For that, their company shares will be issued. That is 60,000 is the purchase consideration, right? So in this case, they have taken asset value, stock value this much, plant value is this much, and then remaining is treated as goodwill, right? So during the year purchase price of the plant, but another plant you have purchased 5,650. See here, assets and balance sheets are given. Now we have to prepare both schedule of changes in working capital and then fund flow statement. Let us take schedule of changes in working capital. Only have to take current assets. Current assets, there is some information is there, that is asset purchase, right? That is stock you have taken 21,640. How much it is there? Stock 1,11,040, right? 1,11,040 previous year, current year 97,370. That means you have to deduct. Why you have to deduct means uh, is- it is purchase consideration. 60,000 is the purchase consideration. It is out of that, it is issued by share capital of that purchasing company, right? So that is why we have to deduct the purchase consideration of stock is 21,640 you have taken from that company, so that you have to deduct it. Now what is the stock value is 75,730. So what is the difference between previous year and current year is decrease. This much is decrease in working capital 35,310. Then the cash at bank as usual, sundry advances, debtors as usual you have to take a total current assets, total current liability you have to take bills payable, creditors, and bank overdraft. These items you have to take as it is. You have to find out what is increase or decrease in working capital. Only stock will be affected. Why? Because non-current item stock, it is not generated by bought on cash. It is issue of share capital. That is why we are deducting. Okay. Then see here. Now you have to find out increase in working capital is this much, right? Fund flow statement, application side, purchase of machinery, it is given in your problem adjustment 5,650 separately. And then tax paid and dividend paid, interim taxation. See here, interim dividend and taxation paid during this year 35,000 and 39,000. You write it in the outflow application side. Tax paid 35,000, interim dividend paid 39,000. Is there any other thing in your liability side? See here, equity share capital 2 lakhs, 2 lakhs 60,000. This 60,000 increased, but you cannot write in the sources side. Why? Because we are not issued for cash. It is given for issued for purchase consideration of purchase of another company. So that 60,000 you should not write in the issue of share capital. Sources side you should not write it. Okay. These are all current liabilities. Provision for taxation, let us treat it as a non-current item. How it will be, right? See here. Let us prepare adjusted profit and loss account for finding funds from operation. Opening balance of profit and loss account is this much. Closing balance is 36,220. Now we have to write provision for reverse. So provision for reverse. One second. Huh? Okay. See here. Funds provision for taxation. Provision for reserve. See here, provision creditor bills payable overdraft will not come. Provision for taxation 40,000 and 50,000. Reserve for 50,000, 55,000 is there. That means 5,000 transferred from profit during this year, right? Transfer of reserve 5,000 you have to write it in the adjusted profit and loss account. Provision here transfer to provision for reserve, not reserve, reserve. 5,000. Goodwill, you have to calculate. How to calculate goodwill? See here, 60,000. You total this 21,640 plus 18,360. Remaining is goodwill. How much comes? 21 plus 18. How much comes, ma? Calculate, anybody?
40,000.
40,000. See your goodwill account. So how much goodwill it is? 20,000. No, remaining is goodwill. 60,000 is purchase consideration. You have taken stock and plant value is 40,000. Okay. So remaining 20,000 is the goodwill. But your balance sheet shows only 19,000. See here, 1,000 rupees it is written off. Do you understand? Purchase consideration is 60,000. Stock value 621,640 plus plant value is 18,360. That means totally 40,000. Remaining is the value is credited for goodwill. But here goodwill account shows only 19,000 instead of 20,000. That means 1,000 rupees written off during this year. In profit and loss, while preparing profit and loss account, you might have written off. So now we have to write in the adjusted profit and loss account goodwill written off 1,000 rupees. Okay, then provision for taxation, you see this ledger account. Provision for taxation account, see here, opening balance by balance brought down 40,000, closing balance 50,000. In your adjustment, taxation paid is given, right? Taxation 35,000 paid during the year. So to cash account, to cash account, that is tax paid during this year 35,000. So what is the provision made during this year? Provision made is this difference, credit side, right? So 45,000. This 45,000 you have to write it in the adjusted profit and loss account, and tax paid during this year you have to write in the outflow side. Applications of fund flow statement you have to write. See here, in funds adjusted P&L account, provision for taxation 45,000 made during this year, you have to find out. right? That is balancing figure,
Yeah.
right? This one,
Send the scan copy.
see here, tax paid 35,000 you have to write in the application side. Okay. Interim dividend you have to write both the places. One is applications of fund side, another one is write it in the adjusted profit and loss account. Then depreciation on land and building, depreciation on machinery, all these things you have to write, and find out what is the funds from operation. This funds from
Excuse me,
operation.
ma'am.
Yes,
Ma'am,
ma'am. Ah.
interim dividend, why we should write both the sides? Because it's coming in adjustment.
Why? Because in adjustment, whatever adjustment is given, it has to be written in two places. Interim dividend, we are treating it as once you are declaring and then you are paying. While declaring, you have to write in the adjustment profit and loss account, and payment you have to write in the application side. That is why we are placing in two places.
Okay,
Okay.
ma'am.
So now you have to close this fund flow statement. Your application side is this much. Sources, that is funds from operation. So difference is increase in working capital. Your sources are greater than your applications, that is 31,890, that is increase in working capital. That should be the same amount what you have prepared in schedule of changes in working capital, right? 31,890. You are either preparing statement, fund flow statement, or schedule of statement. You will get the same answer. But in your examination point of view, what they are asking, the same thing only you have to prepare. Fund flow statement, if they ask, mostly they will ask you fund flow statement only. Sometimes, very rarely, they will ask you to prepare schedule of changes in working capital. So you should be very carefully read the problem, what is the question is asked. So you have to prepare the answer. Okay. Let us prepare one cash flow statement. Then only you can understand what is the difference between this fund flow and cash flow, right? In cash flow statement, we have to take there are two methods. One is traditional method, what we have prepared fund flow statement, same thing. Example, in the fund flow statement, two statement you are preparing, no? Schedule of change in working capital and fund flow. Here only one statement, no schedule, only one statement you have to prepare. Cash flow statement, sources and applications of fund. In that sources side, you have to start with opening cash in hand and cash at bank, and then end with the closing cash in hand and cash at bank in the application side. That is the difference, right? The remaining things as it is same. Non-current item sources, what are the things you are writing, everything you have to write. Then cash from operation you have to find out instead of funds from operation. Cash from operation, how to find out? That is funds from operation, what you are finding, same at that stage, same. Plus you have to find out funds from operation, you have to add some current items and deduct some current liabilities and current assets. So you after adjusting current assets and current liability, that is called funds cash from operation, right? The remaining things are same, that is traditional method. There is another as per international accounting standard, this inflow and outflow of cash, they are dividing into four activities: operating activity, investing activity, financing activities, right? So you can prepare according to this international standards account, that is indirect method, right? Cash from operating activities. Operating activity is nothing but you are getting the cash from operation, right? That is net profit during the year. Then you have to, there is an adjusted profit and loss account. If you prepare, that is you will get it funds from operation, right? Then funds from operation, if you are adjusting the current assets and current liabilities, that is called cash from operation. Okay. This is the operating activity. Cash flows from investing activity. Investing activities, that is sale of fixed assets, purchase of fixed assets, that is intangible Purchase and sale of assets, you have to write as investing activities. Financing activities, issue of share capital, raising fund from issue of share capital, issue of debentures. These are all inflow of cash. Outflow of cash, payment of dividend, payment of financing activity, payment of debt, repayment of debt. All these things comes under financing activities, right? Let us prepare one cash flow statement right now as it is traditional method, right? First let us prepare traditional method, and then one more problem I will teach you how to prepare under international accounting standard, that is indirect method. See here, cash flow statement, you have to start with uh, this is indirect method. Okay, let us see indirect method. Cash flows from operating activity. Operating activity, what are they? Net profit before tax. See here, net profit is given in your problem. Dividend 26,000. See here, capital 1 lakh. Here, this is sole proprietary concern, not a company. So, opening capital plus net profit minus drawings will be the closing capital, right? So, here dividend is given, net profit is not given. You have to find out net profit. So, opening capital plus net profit we do not know. That is the minus dividend, that is the closing capital. So your dividend is 26,000. So what is your uh, see here, working note I have given. Opening capital 1,48,000, closing capital 1,49,000. The difference is 1,000 rupees, right? So 26,000 is the dividend you might have deducted already, but you have to add net profit. Net profit is we do not know. So this difference plus dividend is net profit. 27,000 is the net profit. So see here, net profit before taxation, that is 27,000, plus in the adjusted P&L account we will write no adjustment for depreciation, all the other items, that is that you have to write, that is called funds from operation. Only one item is here, depreciation. Depreciation on building, only depreciation on building. See here, depreciation is also not given directly. It is opening balance 27,000, closing balance 36,000. So the difference is machinery 6,000. See here, machinery 80,000, 86,000. But opening balance 9,000, right? Provision for depreciation opening balance 27,000. Current year it is given 36,000. That means 9,000 depreciation on machinery provided during the year. So 80,000 minus 9,000 you have to deduct it, but the balance should be shown only 71,000. But it is shown 86,000. That means purchase of machinery during this year 15,000. See here, depreciation 9,000. So only one item. So funds from operation. After finding the funds from operation, you are have to add find out cash from operation. Cash from operation, how we have to take? Increase in current liability you have to add, and decrease in current liability you have to deduct. You have to add increase in current liability and decrease in current asset you have to add. Reverse one you have to deduct. Increase in asset, decrease in liability you have to deduct. You understand? Cash from operation, how you have to calculate? Funds from operation plus increase in current liability. Why we are adding increase in current liability? Say for an example, you are getting loan from somebody, right? So that is current liability, your supplier. So cash comes in. That is why increase in current liability, right? So suppose your stock is reduced. That means what? You have sold the stock, so you get cash. So that is why decrease in stock means inflow of cash. That is why increase in current liability and decrease in current asset you have to add. Reverse one, decrease in current liability and increase in current asset you have to deduct. So in your balance sheet, current liability you have to take a increase in current liability, decrease in stock you have to add, increase in debtor you have to deduct. If you do these adjustment, that is called cash from operation, right? Cash from operation, that is for operating activity, cash flows from operating activity. Next, cash flows from investing activity. Investing activity means what? So what are the things? Inflow of investing activity and outflow of activity. So inflow means sale of building, sale of asset, issue of share capital. These are all inflow. Inflow of investing activity. Outflow, what are the outflow? Purchase of land, purchase of building, purchase of machinery. These are all outflow of investing activity. So in this only outflow of activity, investing activity is 30,000. Inflows from financing activity. Financing activity, that means see your balance sheet, loan from partner 20,000 increased. So you are getting loan. So that is inflow of cash. Loan from bank, it is outflow. You have repayment of loan. The repayment of bank loan 5,000 is minus value, right? Outflow. Inflow, you write it in plus value. Outflow, you write it in the bracket minus value. Then payment of dividend 26,000. Outflow of cash. So now net value is cash flows from financing activity is minus value 11,000. See here, cash flows from operating activity plus value 40,600. Cash flows from financing activity 30,000. Investing activity 30,000 minus value. Uh, Financing activity 11,000 minus value. Now what is, you make the minus value 41,000, right? 40,000 minus 41,000. So minus 400 you are having, right? What is your opening cash balance? See your problem. Opening cash balance 4,000, 3,600. So add opening cash balance 4,000 less closing cash balance. You will get the value of closing balance. 4,000 minus 400 value, that will be the closing cash balance. This is the cash flow statement as per International Accounting Standard. That is indirect method of cash flow statement. Cash from operating activities, cash from investing activities, and cash from financing activity, right? The other ledger accounts are similar to that fund flow statement, right? Same thing. I will do one more problem. Not here. One second. Once again, I will show you the traditional method. See here. This is the problem. You are required to prepare cash flow statement. Cash flow statement like fund flow statement, sources of cash, applications are user side. This is the traditional method. You have to start with opening cash balance in the sources side, end with closing cash balance in the user side. The remaining items, how you are writing in the fund flow statement, the sources of fund, whatever sale of asset, and then issue of share capital, issue of raising loan, all these things comes under sources side. Application side, that is purchase of machinery, purchase of investment, payment of taxation, everything will come. Instead of funds from operation, if it is cash from operation in plus value, you have to write it in the sources side, cash from operation. Suppose minus value, if you are getting cash lost in operation, you have to write it in the user side. Your closing cash balance will be get tallied. No increase or decrease in working capital will not come. In cash flow statement, you have to close with closing cash balance. The remaining adjustment, adjusted profit and loss account, as it is same. You have, see here, you have to prepare opening profit and loss account, opening balance, closing balance, then non-trading expenditure and non-cash expenditure, and then other profit on sale of machinery, investment, all these things you have to do the adjustment, find out funds from operation. After finding the funds from operation, you have to add increase in current liability and decrease in current asset, less decrease in current liability and increase in current asset. That you have to do the adjustment, that is called cash from operation or cash lost in operation, right? So provision for taxation, you have to treat always non-current in the fund cash flow statement. Do you understand this? This is the traditional method of cash flow statement. As it is fund flow statement, you have to prepare only the difference is you have to start with opening cash flows, cash from operation, sorry, opening cash balance and end with the closing cash balance. Instead of funds from operation, here you have to write cash from operation or cash lost in operation. Cash from operation, how to calculate? After finding the funds from operation, you have to add increase in current liability and decrease in current asset, and reverse, decrease in current liability and increase in current asset you have to deduct. So you will get the cash from operation or cash lost in operation. Do you understand both the method, direct method and indirect method? Okay. Now you make the difference between fund flow statement and cash flow statement. Fund flow statement, you are preparing two statements, that is schedule of changes in working capital and fund flow statement. In cash flow statement, you are preparing only one statement, that is called the cash flow statement. Either direct method or indirect method. There you are finding funds from operation. Here you are finding cash from operation. Here cash flow statement, you have to start with opening cash balance and end with closing cash balance. Cash from operation, you have to find out, after finding the funds from operation, you have to adjust the current assets and current liabilities. In fund flow statement, you are only, you have to take non-current item in the fund flow statement. Current items you have to take in the separate statement. Here you are adjusting with the funds from operation. That's all with regards to. And then one more thing, fund flow statement, provision for taxation and proposed dividend, you may treat either current or non-current. But in while preparing cash flow statement, you have to treat it as non-current. Okay. There you are finding working capital, whether working capital increase or decrease during the year in fund flow statement. In cash flow statement, you are finding what is the inflow of cash or outflow of cash, or what is the changes in the inflow or outflow, that you have to find out. That's all with regards to your difference between fund flow statement and cash flow statement. Okay, you practice this. Then next class we will complete. We have almost all the problems we have completed. Only some theoretical parts are there. Latest concepts are there. That management concepts that we will see in the next classes. Okay, you practice it. If you have any doubt, you note down and let us discuss. Okay, shall we wind up this class?
Thank you, ma'am.
Okay, thank you.
My voice is audible, ma? My voice is audible, ma? Can anyone say yes or no? Through message itself. That is enough. Okay, thank you. Now we are move on to unit 5. That's come under foreign collaboration. Sorry. That's come under foreign collaboration, foreign direct investment, and followed by foreign institutional investment and offshore country funds, foreign venture capital investment and other foreign investment, and international capital market. Foreign collaboration and FD, foreign direct investment. You can expect question from foreign direct investment. For foreign direct investments, regulation and impact of foreign FDI of the Indian economy. Regulation and impact of FDI on the Indian economy. So we already discussed FDI role. FDI role is very important role to impact on Indian economy because FDI they do a business in India. Indian government will exemption of all the taxes. They'll give benefit to the FDI because inflow and outflow of money is very important. Money circulation is very important. Financial stability is very important. Economic stability is very important. Price stability is very important. So along with this purpose and also creating employment opportunities, uh, generating per capita per income per individual, then standard of living, employment opportunities, and followed by health index, education index, and social index. All the index are very important. Suppose if you take it as an example of Maslow theory, first principles of management, you studied Maslow theory, hierarchical theory, that is fulfilling the need of basic needs, then followed by secured needs, job, basic need, food, shelter, cloth, and secured needs, and followed by other needs, and end up with extreme needs, enjoyment and entertainment. So what they expect, at least they need fulfilling the requirement of rural people, basic needs, food, shelter, and cloth, and other needs we will fulfill by government of India. It's quite difficult to fulfill the needs of basic needs of to the rural people and urban people also, metropolitan people also, slum people were there, many below poverty line people were there. Their day to day life is quite difficult to survive in any form of life. So you want to generating employment opportunity, not only a high class, highly profiled people, because we running the government not only highly profiled people to bottom line people. All the people is very important. All the people were living in India. We are all citizen of India. So economy also, based on economy also, you can diversify. The economy also, overall economy also contribute to everyone. Benefit of welfare of state and welfare of nation and welfare of individuals. All the benefits goes to below poverty line people, middle class people, and high class people. All the people getting benefit from where employment opportunity. Without employment opportunity, we can't run any business. We can't run any economy. We can't run Indian economy. It's quite difficult because crisis were happen, financial crisis were happen, then followed by food crisis were happen. So food crisis were happen means automatically some out of illegal activities were adopt. So illegal activities were entered into India. So for we want to stop all this process, what way you can give solution to this problem? Definitely solution based on employment opportunities. Solution based on employment opportunity. That the employment opportunity, how foreign direct investment directly impact on Indian economy based on employment opportunities, and followed by the economy flow, income of economy for every individual, and followed by standard of living, and followed by other variables were there. So FDI to support the Indian economy, directly impact on our Indian economy. Some of the rural areas were not developed area, underdeveloped area, want to develop by Indian government. They opened the gateway. So already we opened the gateway of what? LPG, liberalization, privatization, globalization after 1992. Our former Prime Minister Narasimha Rao, with the help of former Prime Minister and Finance Minister, our Manmohan Singh. So various committee were there, various committee were proposed, Narasimhan committee, Rangarajan committee, many committee were support LPGs. Many committees were support the LPG, and also many committees were including the technologies, computerized, decentralize all the systems, decentralize all the systems. Though banks were play a vital role in the Indian economy. They were the backbone of our economy, and also they did many revolution, financial revolutions. Financial revolution were in India. The present days, all the business were running the support of banks. So FDI is also very, very important. Foreign direct investment, foreign direct investment. Suppose you are doing more and more export, the country having excess of foreign reserves. The country doing more and more import means the country economies is fall down because we are dependent on other countries. We didn't produce any product. We didn't fulfilling the need of domestic people needs because we are dependent on foreign product. So we import more, we lost our foreign reserves, we lost our foreign reserves. We want to improve our export. Indian economy want to, Indian government want to improve the export. We also produce more product. Based on that, you create more employment opportunity and using the natural resources, utilizing optimum utilization of resources, natural resources within the countries. We don't want to import other countries' product, other countries' resource material, raw material. You don't purchase a raw material. Whatever resource you are having in your country, you can use that resources. You can use that resources. So open the gateway of FDI. FDI, when enter into the Indian market, we transfer the employment, we transfer the management, we adopted the new technologies, not only business purpose, not only foreign resource purpose. We adopted everything. We adopted a new technology. We adopted management, new management, and then so many educations, culturals, everything we can exchanging between the two countries. So FDI will support all the sides. FDI support all the sides. So foreign direct investment policy in India formatted by the Department for Promotion of Industry and Internal Trade, DPIIT, will promote the foreign direct investment. DPIIT, Department of Promotion of Industry and Internal Trade, DPIIT, under the Ministry of Commerce and Industries. They were promoting the FDI, foreign direct investment. What are the area, underdeveloped area? They find out that area, the allowing the foreign people do a business that area. So do that area. So land value will be increased based on that business. Land value is increased. Then road and transport, road nearby water facilities and nearby hospital facilities, nearby education facilities, and followed by infrastructure facilities. Slowly they are developed based on FDI, foreign direct investment. They invest money in underdeveloped area, invested money in underdeveloped area. Slowly domestic income also be increased, and domestic people were enjoying the benefit of employment opportunities. So automatically the domestic people will enjoy the per capita per income standard of living. Based on that, all the sector were benefited from FDI. So all the sector means education sector, hospital sector, hotel sectors, and followed by industrial sector, cement companies, all the companies, infrastructure companies, followed by all the business were developed. They'll give job to apprentice to top level people, apprentice, direct employee, indirect employee. Then India is based on two sector. One is uh, government sector and private sectors, and also two types of employment also, the regular employment and irregular employment. So the two people were enjoying the benefit. So based on foreign direct investment, foreign direct investment. FDI invested money in India. Once they invested money in India, automatically uh, all the sector were grow the process and grow like anything. Then all the sector getting benefited. The money inflow and outflow go here and there everywhere. The money circulation were there, the circulation is going, then finally they end up with Indian economy, supported to Indian economy. For what purpose? The policy aim to attract foreign capital. That's the main aim. They attract foreign capital. We attract foreign capital because we don't want to put any tax or anything. We exemption of all the tax. Exemption of all the tax. Foreign capital we attract. Foreign capital attract, exemption of all tax. It's the main aim. To attract, the policy aims to attract foreign capital to promote economic development and the technological advancement within the countries. What I told earlier, beginning I told, we exchanging of not only business, exchanging not only attract the capital and also exchanging the new technologies. Previously, what will happen? Someone, we are not present days, they are sitting anywhere in the world, they control their management, control their entire industries. And previously, what will happen 1990 before in India, foreign company somewhere they're sitting, their employee every time come over here and monitoring the business, monitoring the business, and they are anything new equipment they need, they import from foreign countries only. And any technological people need means they are come from foreign only. Any service support people also coming from foreign only. All the types of services they're expecting the people from foreign countries. But FDI present days, what will happen? They don't need, no need to import people from foreign countries. Whatever resource is there in the country, they utilizing the resource from the same countries. They don't go for import the people from other countries, technology service or any other equipment service or mission service or anything to be happen. They use the service within those countries. That's why we're changing the education, changing the technology, changing and everything, exchanging everything between the countries, because we are now a digital world, a digital era. Digital era, it will support. You can sit in anywhere to control your management, to control your any country. That's a foreign collaboration. The main that is capital to promote economic development. It encourages foreign enterprises to either establish a presence or collaboration with Indian businessmen, either they merge with other Indian company or they are directly they are open their business in India, direct way or both merger way or merger acquisition or conglomeration with different way of method we are using to start a business in India. Then types of foreign investment routes. What are the routes? So FDIs in India is governed by the Foreign Exchange Management Act, FEMA, 1999. Previously, in 1970, they were using Foreign Exchange Regulation Act that will be changed into Foreign Exchange Management Act, 1999. It's undertaken through primary routes. Two routes were available. We are using in foreign business or foreign investors. The two routes, automatic route, they allow foreign investor to invest without requiring prior approval from the Reserve Bank of India or government in certain sectors. They are without any pre-approval from Reserve Bank of India because we attract foreign investors. They are investing money in India. Foreign institutional investors, they are investing money in foreign, say Indian stock market. That's why we call this automatic route. This allows foreign investors to invest without requiring prior approval from the Reserve Bank of India because all the transaction will be recorded. Foreign transaction will be recorded. All the transaction monitored by RBI, Reserve Bank of India. All the transaction, capital account and the current account were recorded in the balance of payment. So that show your foreign reserves, how much reserves India have. So based on that, here FII, foreign investors to invest without requiring prior approval from Reserve Bank of India or government of certain sectors only. Then government route. Two routes are available for FDI, either government route. In sector not covered by the automatic route, but prior approval from the government is required through Foreign Investment Promotion Board, FIPB, separate board were there. Suppose you want to invest money in India to start a business, to operate your business, that's a government route. In sector not covered by the automatic route. But in automatic route, we don't need any prior information from RBI. But here, we need permission from the government of India and separate sector, separate institution we are running. Foreign Investment Promotion Board, FIBB, FIPB. So these are the routes we are doing business in India, either automatic route or government route. Foreign collaboration, foreign direct investment I am discussing here. Then modes of foreign direct investment, modes of foreign direct issuance of fresh shares. Issuance of fresh shares. What is my issuance of fresh shares? Means foreign company tie up with the Indian bank or foreign company merge with Indian company. Foreign company acquire any Indian company or foreign company directly open the company in India. So they also not only Indian businessman or Indian company, Indian corporate company issuing IPO to the public and foreign company also issuing IPO to the public. Along with what Indian companies may issue new shares to the foreign entities under the FDI scheme. Indian companies may also issuing new share to the issuing for foreign entities or foreign companies under the FDI scheme, subject to compliance of FEMA and pricing guidelines by the RBI, set by the RBI, pricing guideline set by the RBI. That's the issue of fresh share. Then transfers of existing share. Foreign entities can acquire shares companies by purchasing them from existing shareholders under the certain conditions. And the existing shares also transferring existing share to the foreign company, that is also coming under FEMA Act, Foreign Exchange Management Act. Then foreign entities can acquire the share companies by purchasing them from existing shareholder under certain conditions. Certain condition by SEBI and RBI and a Foreign Exchange Management Act. Under this, you can certain condition you can share the existing share to the foreign companies. Impact on Indian economy. What is the direct impact on Indian economy through FDI? Enhancing capital formation. That's by bringing foreign capital. FDI has contributed significantly to Indian capital formation, leading to increased investment in infrastructure and manufacture and services. This is the main aim of government. Why we attract foreign investment? What is the purpose of to attract foreign investment? Significantly, they contributed to our capital formation. Capital formation, initial investment they invested in India directly to what? Infrastructure, manufacturing and services. Then technological advancement and skill development. FDI is always encourage transfer of skill development and foreign companies bring new technology and management practices. Already I told, already discussed what they bring to India. Foreign companies management as well as new technology and followed by new skills. They exchanging foreign country to India. India also adapting new technologies, new skill set, and the uh, new technologies, new skill set, and new foreign companies. So this all should be meaning management practices, because in India TCS follows some management practices. Then in foreign companies like Microsoft merge with the TCS means Microsoft different management process, different management perspectives. CEOs are different. The leading people are different. So they here, and also Indian companies, we have traditional orthodox management practices. Both are combined together means we see that new management practices. For that purpose, we are exchanging the enhancing the capital formation and technological and advancement skills. Then, what is the main purpose we attract FDI? Employment generation. FDI is a substantial driver of job creation. FDI is a substantial driver of job creation as multinational corporations establish production facilities and service centers and which provide employment opportunities across skill levels in India, across the domestic level, across the national level, across the state level. They're generating employment opportunity to the Indian people. Based on that, we are called as what MNCs, multinational companies. Multinational companies establish production facilities and service centers and followed by provide employment opportunities across the countries. For that purpose, we allow FDI, foreign direct investment, government of India to allow to do a business in India. Main purpose is to generate employment opportunity. Then regulatory compliances and reporting. Regulatory compliance is very important. Pricing guidelines. FDI investment listed companies are regulated based on the market price determined by SEBI guidelines. The market price determined by SEBI guidelines. SEBI guidelines totally they follow FDI people, foreign direct investment, because they want to list it in the Indian stock market. Their company also be listed in the Indian stock market. After that, FDI investment is listed in companies are regulated based on the market price determined by the SEBI guidelines, because the FDI market price determined by SEBI guidelines. Then unlisted companies, as far valuation is conducted by the registered entities. This all foreign exchange regulation. Then reporting requirements, what they needed for reporting requirements means investments are closely monitored or reported to the RBI. All the investment are closely are reported to the RBI, because all the transactions should be monitored by Reserve Bank of India. All the transactions should be reported by transaction recorded by Reserve Bank of India. All the foreign transaction. That's why reporting requirements much needed, because that money will be illegally transferred to some other purpose to create a problem. Hawala, terrorist money, anti-money laundering act. So this for that purpose we want to protect that money, and also that money utilized for the development of the public, development of the Indian economy, not that money to use for other illegal activities. We want to stop the money to going to illegal activities. Based on that, RBI will closely monitor and reported to the RBI, which helps maintain transparency and proper regulatory oversight. Then challenges and concern. What are the challenges faced by FDI and foreign collaboration? Control over strategic sector. These are concerned with the excessive foreign ownership in strategic sector could be affect Indian economic and sovereignty. Definitely, because excessive many sector were governed and owned by FDI. That will be definitely affect Indian economic and sovereignty. Then market volatility. FDI inflows can sometimes lead the volatility of Indian market. The market is always volatility in nature. FDI sometime maybe to lead the market volatility in our stock market, because market is always zigzag in nature, market is always bubble in nature, markets always uh, bubble and zigzag, uh, and it's never stable in nature. So based on that, foreign FDI inflows, FDI money flows also to lead to volatility in stock market. And particularly if foreign investors withdraw their investment during economic downturns, that will be big fall down for Indian economy. FIR, your economics very strong economy, FII, foreign institutional investor ready to invest money in Indian stock market. Suppose our market will be fall down based on political crisis and followed by economic crisis, followed by any other crisis impact on stock market, suddenly that foreign institutional investor withdraw their investment from the Indian stock market. That is also to be affect our Indian economy. Then labor and environmental standard. Foreign firms may at times not adhere to the same standard for labor and environmental regulations in local counterparties. That is the main challenges concern. Then future projects and reforms. India continues to reform FDI policies to make investment climate more attractive. That's very, very important. Nowadays, the Indian government will face the climate changes. Climate changes will affect our economy. Climate changes will affect our not only economy, natural. So we cannot predict our climate. Climate economy will affect our individual economy as well as national economy and global economy. For that concerns, we reforms our policies. We every day update our policies based on FDI, foreign direct investment. They don't want spoil our environmental ecological structures. Based on that, we allow do a business in India. That is future perspectives and reforms, green finance, green infrastructures, followed by other green related market they were open in India, green related industry they were open in India. India also benefited, the company also benefited, and also environment also benefit from that country. This is a future prospect and reforms. Then followed by foreign institutional investment and role and influence of foreign institutional investor in India. Foreign institutional investment, the role of foreign institutional investor in India. The foreign institutional investments, FIA play a crucial role in India financial market, impacting both capital flow and market stability. Already I told they were more number of people were entering into Indian stock market. They enjoying the benefit based on our economy. Suddenly withdrawing all the FII means our economy will fall down. That's why it's impacting both capital flow and market stability. Define and portfolio investment. FII companies, various institutional investors such as pension funds, mutual funds, and asset management companies and trust and followed by Indian markets through equity and debt instrument registered under Securities Exchange Board of India, SEBI, Security Exchange Board of India. FII must comply with a set of regulations to India economic growth and with ensuring transparency in financial transaction. That is very, very important. Transparency in financial transaction. And also they were registered under the Security Exchange Board of India. So FII to invest money in Indian market along with help of they are investing money in both equity and debt market, debt instrument and registered under Exchange Board of India, Stock Exchange Board of India. And the role of FI in Indian financial system. Their role is main role, capital infusion and Indian market development and the market volatility and speculation based on FII and followed by influence regulatory framework and limitations and exchanging trade derivatives and hedging mechanism. They were trading the water, exchanging trade and derivatives and hedging mechanism. Positive impact of FI in economic growth, strengthening the capital market, improving the corporate governance and transparency, because corporate governance transparency nowadays very effective in India. Improving corporate governance and transparency, strengthening the capital market, and challenges and risk associated with the FII. What are the challenges? What are the risks associated with the FII? Sudden capital flight and economic disruption. Already told. Suddenly they withdraw all the monies. Withdraw all the monies from stock market. That is called a sudden capital flight and economic disruption. Disruption is error. It will be happen. Then regulatory and sectoral restriction. Government of India to restrict the FII people. Other sector they do not invest money in India because they withdraw that money for only some sector they're going to invest money in India, like to prevent excessive foreign control. FII are restricted from investing in sector like real estate, agricultural, and other sensitive areas. They do not invest money in real estate and agricultural sector because real estate, agriculture, suddenly they're booming like anything. Suddenly they withdraw their money. So who will affect you? Indian domestic domestic investors were affected due to increasing real estate and agriculture sector. It's a sensitive nature because it's always bubble in nature, forced by market condition. All the value of that product is forced by market condition. That's the very sensitive areas. The government of India uh, restriction restricted by the FII to invest money in real estate and agriculture and other sensitive areas. And also ARC. Additionally, FIR prohibited from investing asset reconstruction companies like a certain non-financial business. So, future of FII in India. Future is as the Indian government continues to liberalize the economy, all the sectors should be liberalized and privatized and globalized economy. This is future FIA India because all the economy is liberalized, privatized, and globalized. So it's expected to grow because the money flow will be expected to grow. Foreign money circulation will be expected to grow in Indian economy. For that purpose, Government of India allow LPG in India, and also ease of business. The restriction ease of business also be exempted from some restriction are exempted from foreign people to do a business, and also it create opportunities to attract foreign money to invest in India. Then other one is offshore funds, offshore country funds, and the foreign venture capital investment, other foreign investment and international capital market. What is meant by overview of foreign investment types? Offshore fund, foreign venture capital, and other investment vehicles. It's a offshore fund means offshore funds are investment funds registered or based in countries outside the investor in home countries. Investor home country. Offshore funds means offshore funds are investment fund registered or based in countries outside the investor from home country. That's called as we attract offshore finance and also our country people to invest money in outside countries. That's called as offshore funds. They are often established in region with the favorable tax laws to attract foreign investment because they are attract tax with invest money in other countries, what they expect interest rate. The interest rate putting more tax means they are not ready to invest money in other countries. So some taxes, enjoying the benefit of taxes, they are investing money in offshore funds, foreign investments. Discussing offshore fund structures, benefit and common location like Cayman Island, Luxembourg will provide an understanding of why investors attracted offshore funds. You know that Cayman Island, followed by other island. The island were running the countries based on these offshore funds. They were exemption from taxes, exemption from the tax benefit. That's why they are ready to invest money in offshore funds. Then foreign venture capital. Foreign venture capital means venture capital means what is mean by venture capital means new business, initial business. The people were doing new business. That is called as venture capital. Venture capital, foreign venture capital. They're ready to lending money to the new business people. They're identifying the new people, identifying the new people. They're lending money to the new business. Don't foreign company identifying the outside new business. They're lending money to the outside business. Those who have not money, they need of money. They're borrowing money from business, new entrepreneur, identifying the new entrepreneur to do the to lending money to the new business. That is called as venture capital. Venture capital funds, they focus on investment in companies outside fund originating country. That funds help scale companies by providing capital for growth and emerging markets. Scale companies. Foreign venture capital's role is technology and startup ecosystem. I already told startup companies, they're lending money to the startup companies, particularly region like Southeast Asia, Africa, and Latin America, highlight its global economic impact. That's a developing countries. So venture capital, foreign companies, foreign institution, financial institution, lending money to the startup companies outside countries like Latin America, Southeast Asia, Africa, followed by other global economy impact. It also created a global economic impact. Then other investment vehicles like other vehicles means such as private equity, hedge fund, sovereign wealth fund, and followed by offers a diverse set of approaches of international investment. This is called as offshore funds, foreign venture capital, and other investment. Thank you so much, Ma. We'll discuss all the 5 minutes. We'll see all the best for your exam. Thank you so much.
Good afternoon.
Good afternoon, sir.
What is the subject now actually, as per your timetable? Is it given as project management or something else?
We didn't receive any timetable, sir.
You didn't receive. Okay, no issue. So let me now take up the class and continue the project management. So I just wanted to start from where I was stopped yesterday. This is the place where I was stopped. Project roll-up is to be taken up. Other concepts we have discussed in the last class itself. Some more concepts are there to cover up the first unit. So let me now take up the concepts which were left yesterday in the unit number 1 and complete that. After that, let me move on to unit number 2. So project roll-up is another concept to be discussed under this unit number 1. What this project roll-up is. It is the technical term which is used in the project management to describe the process of aggregating the performance or status of multiple individual projects into a consolidated report. So when there are multiple individual projects are working simultaneously, I think yesterday I have told about one concept, namely project portfolio management system is followed. Along with that, we have this project roll-up system also. When we have multiple individual projects working simultaneously, if at all, a particular executive or a stakeholder or a manager or some other person, some important stakeholder wanted to know a specific position regarding the status of all the individual projects. Say, for example, a particular aspect called what is the cost status, or what is the timeline status, what is the resource utilization status, something like that. If a particular concept is to be, a status about the particular concept is to be known, then we resort to the technique of project roll-up. It is a process which occurs at the higher level of the project portfolio, where some executives or stakeholders wanted to know or wanted to get a holistic view of the complete status of all related projects. So this can be applied under various contexts. For example, in financial reporting, you can apply this roll-up concept. Or if at all you want to know the resource management status, then you can apply this roll-up technique, wherein we have to consolidate the resource management status of all the multiple individual projects working simultaneously and submit a report to the person who is asking for that. Suppose an accountant asks for financial reporting, you have to prepare a financial reporting, financial status of the all the projects at a particular point of time, and that is to be reported to the accountant. Like that, if some risk management is asked about the risk management, the company wants to know the status, then you can prepare a consolidated report about risk management and give it to the management. Suppose if the management wants to know the performance tracking, then a separate report regarding performance tracking can be consolidated and give it to the submit to the person who is asking for it. So this is called roll-up. So this will help you to monitor and manage large portfolios of projects very efficiently by providing a clear and high-level summary of key metrics, say risk management, resource management, financial reporting, performance tracking, or about the cost position, or about the timeline position. These are the key areas, key aspects about the key metrics and its outcome. If at all high-level machinery is what we wants to have a summary, then we resort to this roll-up technique. Now, how this roll-up technique can be been applied. What are the steps involved in performing the roll-up status? So what which let us discuss now. Is it visible on the screen now? Steps in performing a project roll-up?
Yes, sir.
Yes. So at the first step, we have data collection. So whenever a person wants to submit a roll-up report regarding a particular concept like cost, time, or quality, or risk, whatever it is, then he has to collect relevant data from all the individual projects. That means it may be status updates, or it may be about budget and cost, or it may be about milestone achievements, or it may be about resource utilization, or it may be about risk assessment. So, about this any particular point, he has to collect data from each project. Then comes data aggregation. So, all the collected data is to be consolidated into a single view. Say, for example, we may combine the status reports from multiple projects into one portfolio status report. Suppose that you want to know the say budget position, that is the how much amount of money has been spent so far, about which you want to know. Then we collect information from each project. All this information are consolidated together and in a single view and submitted in the form of a report. So that is called data aggregation, where the performance of all projects is aggregated into categories like, say, the projects are on schedule, or the projects are delayed, or the projects are at risk. So finally, we have to do the recommendation. This is on schedule, or this is at risk, or this is delayed, something like that. So all the data are collected, consolidated into a single view to give a combined status report from multiple projects into one portfolio status report is called data aggregation. Then summarizing the metrics. So metrics may be overall project health, that is called status, or budget and schedule, that is time schedule. This is called overall project health. Metrics may be about overall project health, or it may be about risk exposure. How much risk is involved? What are the various types of risk to which the project is exposed to? And what are the various issues that is going to come across while executing the project? That is called risk exposure metric. Then resource allocation, whether all the resources in the form of human beings, cost, money, and other things are being allocated optimally or not, whether there is any overutilization or under resources. That is to be another metric. Then financial performance regarding cost and budget estimates. How much cost has been incurred, whether the cost incurred is according to the budget or not. If not, what is the variance? All these things are called financial performance. So the metric may be either regarding overall project health, or about risk exposure, or about resource allocation, or it may be regarding financial performance. So whatever it is, that particular key metrics are to be summarized. Then identifying the trends and issues. So the person who is in charge of preparing a roll-up report must look for common trends that is taking place, are the risks that are involved, are the issues that the project is going to face. Because the common trends, risk and issues might be affecting the multiple projects. Therefore, this identifying the risk, identifying the trends and issues could help in identifying systematic problems. Say, for example, repeated delay can be easily found out due to resource constraint. Delay may arise because of many reasons. Suppose, due to resource constraints, if the delay occurs, it can be easily identified once you go for project roll-up technique. Then finally, reporting to the stakeholders. So after collecting all these things and summarizing everything, prepare a report in a format that is suitable for the audience. Audience here, stakeholder. He may be a team member, he may be a team leader, he may be a manager, team manager, or he may be any other person, client or sponsor or any other person who is interested in the project. So what is the format in which it is suitable for a particular stakeholder? In such a way, it should be prepared. So, suppose executive summaries for senior management may be prepared. Sometimes detailed reports for program managers may also be prepared. Whatever it is, the report should highlight the key information such as the progress of the project, financial status, risk involved, and any other action specifically required for the particular stakeholder. So reporting to the stakeholder in the format in which it is suitable for that particular person. Then, based on the report, review and action will be taken up. The stakeholder who is receiving the report, say for example a senior management or steering committee or the client or the sponsor or whatever it is, they may use it as a basis for decision making. So discuss any required corrective actions or resource reallocation to address the issues highlighted in the roll-up reports. So once the report is received, if at all some necessary is there, then they will discuss about the required corrective action if any. Or if at all resources are to be reallocated, then the method or the strategy will be devised accordingly. So what is the problem or what is the issue that is found through this report will be sorted out easily, solved out. So this is how a roll-up report is being prepared. So next let us move on to the next concept, namely process breakdown structure. Process breakdown structure. Is it visible on the screen now? Process breakdown structure, PBS. Is it visible?
Yes, sir.
Yes, let me now go through this quickly. This PBS, process breakdown structure, PBS, is a diagram actually. This diagram is used to decompose a project into various processes or activities. So this diagram, PBS, is a diagram which is used to decompose a project into various processes. It defines clearly the processes are otherwise known as activities or otherwise called actions that need to be completed throughout the project life cycle. So from the beginning to the closure of the project, what are the various actions to be completed, about which a complete set of activities to be done is prepared and a diagram is drawn. The diagram is known as PBS, which contains details of all the processes or all the activities or all actions to be undertaken throughout the project life cycle so that it can be successfully completed. Now, each level of PBS represents a detailed breakdown of all the processes so that you can allocate the resources easily, schedule the task, and monitor the progress. So, what is the use of this PBS? It is helpful to allocate resources effectively, and it is helpful to follow the schedule promptly, and it is also helpful to monitor the progress of the project effectively. When you know complete list of various activities to be undertaken, then it is very easy for everyone to allocate resource, to monitor, to see that it is being done as per the time schedules. Now this PBS, just a moment. What are the key elements in this PBS? About this, let me explain now. Key elements in the PBS. One is hierarchical structure. Number two, process focus. Number three, clear identification of process relationship. And number four, granular details. Let me quickly go through this. When you say hierarchical structure, the PBS, process breakdown structure, organizes processes into different levels, starting with high level process at the top and breaking them down into increasingly detailed sub process at lower levels. Is it visible on the screen now?
Yes, sir. Yes, sir.
There was some network issue. I'm extremely sorry for the inconvenience. Let me continue now. So as far as this process breakdown structure is concerned, I have shown an example on the screen now, how a particular work is divided into various levels and sub-levels. Say for example, we have taken an example of software development project. Is it visible now? Software development project. Because that may be familiar to most of you, most of us. No? So how to uh, fit in a software development project under process breakdown structure, about which I am going to just discuss with you now. Is it visible now? Let me continue.
Yes, sir.
Yeah. At the first top level, the idea is software development project. This is the overall process or the goal of the project. Okay. Then it is divided into different levels. Level 1, major processes are identified: planning, designing, development, testing, deployment, and maintenance. But this is given for an example only. Some steps might have been left here. Just excuse that. For example, only I will give this. Level 1 in software development, the project contains major processes like this: planning, designing, development, testing, deployment, maintenance. Level 2, we have taken one particular major process, that is design, separately. Design is a sub process, right? Sub processes under design. I think, sorry, design is the major process. Under design, what are the various sub processes that is given in the level 2? So sub processes under design: system architecture design, UI UX design, database design, or API design. Like that, level 2 gives sub processes of main process design. Okay. Now let me move on to level 3 now. Level 3 is detailed activities under system architecture design. System architecture design is a sub process under level 2. Am I correct? System architecture design is a sub process under level 2. Under that, again, what are the various activities to be performed? That is given under level 3. So define system components, define data flow, select technology stack. These are the sub processes under system architecture design. System architecture design itself is a sub process for design process. Again, the level 4, you take up this define data flow under level 3. Define data flow is one of the sub processes under level 3. That define data flow sub process may again be subdivided like this: create data flow diagram, identify data sources, define data store management mechanism. So these are the various sub processes under define data flow. Define data flow itself is a sub process under system architecture design. System architecture design is a sub process under design. Design is one of the main processes of software development project. This process is known as process breakdown structure. I hope you could have understood the concept now. Shall I move on to the next topic now?
One second.
Yes. Now the next topic is responsibility matrix. Responsibility matrix. Is it visible on the screen now? Responsibility matrix. Is it visible?
Yes, sir.
Yes. Okay. Now this matrix. You know the meaning of matrix. Matrix contains of rows and columns. No? So something is going to be represented in rows and columns. That something is about responsibility. Therefore, it is called responsibility matrix. It is a tool in project management which is used to clearly define and clarify the roles and responsibilities of various team members within a project. You know that every project contains team members. What is the roles and responsibility of each and every team member that is being expressed in a form of matrix. That role relationship matrix is called responsibility matrix. To put it in very simple words, who is responsible for what at each stage of the project is clearly depicted through this diagram. Such a diagram is known as responsibility matrix. Many types of responsibility matrices are there, but most widely and commonly used method of responsibility matrix is RACI matrix. RACI matrix. RACI matrix. Let me now explain what this RACI matrix says. Just a minute. Let me explain now. RACI, RACI matrix. It is the most widely used type of responsibility matrix. R stands for responsible, A stands for accountable, C stands for consulted, and I stands for informed. Let me show an example so that you can understand the concept. Just a minute, please. Just a minute, please. I'm just in search of that. Is it visible on the screen now? You see that? RACI matrix.
Yes, sir.
Yes, now let me explain this. So here, row wise, we are given requirements, design, development, testing, and final review. These are the various tasks to be performed by different people: project manager, developer, quality assurance tester, and business analyst. So in these columns, we have given A, C, I, R, something like that. What does it mean? I pointed out the meaning of this already. RACI, R means what I told you. R means, what is that R?
Responsible.
Responsible. A, accountable. C, consulted. I, informed. Now let us see. This A means accountable. What is A here? First, 1 1. In the cell number 1 1, requirements for project manager is concerned. He is accountable for the requirement. That is the meaning of it. If we move on to cell number 1 2, that is developer for requirements. C. So what is the role of developer? He can be consulted. That's all. Then 1 3, cell number 1 3, quality tester regarding requirements is I. He is informed about that. That's all. Then business analyst role is responsible. So he is responsible for the requirements. That is the meaning of this Rasi matrix. So here it clearly shows who is responsible for what, who is accountable for what, who is to be consulted, and who is to be informed. Everything is very clearly given. Now, if you take the cell number 33, what is given? 33.
Responsible.
Yes, please. What is given? Whether it is
R,
A, R, C, what is there?
R,
33.
cell number 33, R, sir.
That is 43. R is 43. 33. Requirement, design, development. Development is the third row.
C, C.
Third column, project manager, developer, quality assurance tester. That is C. So you
C.
can easily identify the role and responsibility of various persons involved in different tasks. That matrix is known as responsibility matrix. Okay, are you able to understand this now?
Yes, sir.
Now, with this, the major topics in unit number 1 are over. Let me now move on to unit number 2. So let us move on to unit number 2. I think the syllabus is given on the screen now. Unit number 2. Is it visible on the screen now? Unit number 2. Is it
No, sir.
visible? Not? Okay.
Visible, sir.
Visible. I think it is visible, yes.
Now visible.
Okay. So what are the various concepts to be discussed under this unit? Unit structure is given now. Unit structure. Project feasibility studies, pre-feasibility study. Then next major topic is managing project resources flow. And another topic is project planning to project completion. Then project life cycle and project constraints. These are the various concepts to be discussed under this. Let me now take a project life cycle to start with, so that it will be easy to understand the other concepts now. Project life cycle. Let me start with project life cycle. Visible? Is it visible on the screen now? Project life cycle?
Yes, sir.
Yes, sir.
Yes. Okay. So as every human being, we have our life cycle. You would have studied in marketing management, product life cycle also. Similarly, a project also has its life cycle. It refers to the series of stages that a project has to go through from its initiation to its completion. So, what are the various stages or phases that a project has to go through from the initial stage to the completion stage are called collectively project life cycle. It is providing a structured framework which will guide the project team from its commencement to the completion. And at the same time, it will ensure systematic planning to systematic closure. So, in managing risk, in managing resources, in managing the timeline effectively, and to deliver the project successfully on time, project life cycle understanding is very, very important. What are the various stages in this project life cycle then? So it is given in the stages of project life cycle. Initiation phase, planning, execution, monitoring and controlling, and then closing. Let me explain one by one these stages. Let us first move on to initial stage. This stage marks the beginning of the project. Before planning begins, a project must be initiated. Under this stage, it establishes a foundation, it lays a foundation for the entire project and its subsequent success. It focuses on defining the project at a higher level and securing the authorization of the authorities to proceed further. That is called this initial stage or initial phase. It is the beginning of the project. It gets you the authorization to proceed from the higher level authorities. So, what are the various activities to be undertaken, to be performed under this stage? They are called the key activities. One is we have to define the project clearly. That means clarify the purpose of the project, that is objectives of the project, and then the scope of the projects, and then deliverables. That should be very clearly defined under this stage. Then second important activity is conducting feasibility study, about which we are going to discuss separately later on. Conducting feasibility study means a preliminary assessment is to be made to find out whether the project is viable or not. So assessing the feasibility of the project in terms of technical feasibility, financial feasibility, operational feasibility, etc., will definitely ensure that the project aligns with the organizational goals. So first of all, you have to define the scope, objectives, and deliverables. Then conduct a study to find out whether the project is viable or not, and that will ensure that the project aligns with the organizational goals. Under this feasibility study, you may undertake technical study, financial study, or operational study like that. Then the third important activity is identify the stakeholders. Identification of stakeholders. Identify who are your key stakeholders and find out their expectations. I told you already, stakeholders are the persons who are interested in the outcome of the project. So who are they? What are their expectations? That is to be clearly identified. Then comes getting approval and authorization. Securing approval from the key stakeholders and getting the authorization to proceed is important under this stage. Then you have to develop the project charter. Project charter is a document, a formal document, which will authorize the project, defines the objectives of the project, and defines the high-level requirements. Then it also defines the project scope and the initial risks involved in that, and who are the stakeholders. So all these details are there in the project charter. What is that? Objectives, requirements, scope, initial risk, and stakeholders. So a document containing all these details are called project charter, that is to be developed. Then if the what is the outcome of this stage? Once this stage is over, the outcome is two important outcomes. One is project charter is approval. Number two, decision regarding whether to move forward with the project or not is taken. If at all it is not viable at this stage itself, it will be stopped. If it is viable, it will be proceeded further. Therefore, based on this first stage, you can take a decision whether to move forward or not. That is the outcome. Now let us move on to the second stage, planning stage. Just a minute. I think now it is visible on the screen, planning stage.
Yes, sir.
Yes, it involves, it is like planning. What is the meaning of planning? You are student,
Deciding.
you are, yes, deciding. Yes, please. The same thing we are going to do here under a project. So planning is the process of deciding in advance what to do, how to do, where to do, how, by whom to do, and when to do. That is called planning phase. So under this stage, detailed efforts to organize the tasks, different tasks, what is to be done, then allocate resources carefully, and then define clearly the path forward. What is the way in which we have to, how to do, what to do, when to do, where to do, and by whom to do. All the details are given under this. So it is acting as a guide for the team members towards achieving the objectives of the project. It is like a roadmap. It is like a roadmap of the project. So under this stage, what are the various activities? Define the scope. Scope is to be very clearly defined in a statement called scope statement. What is to be included, what is to be excluded. That is to be very clearly stated in this scope, that is called scope statement. Then we have to create work breakdown structure, breaking down the scope into very smaller manageable units. That means decomposing the project into smaller manageable tasks and deliverables is called work breakdown structure. And then the third one is schedule planning. We have to develop a timeline for completing the various tasks of the project. For that, you may resort to the help of CPM, critical path method, PERT, program evaluation review technique, Gantt chart. So time schedule is to be very clearly prepared for each and every task. Then comes resource planning. That means various resources like people, equipment, material, money, etc. are required. All these resources are to be allocated to complete each task effectively. So here we have to create a resource plan to track whether the resources allocated are optimum or whether they have been utilized effectively. To find out that, you have to create a resource plan. Then budget planning. So develop a budget that will cover all the project expenses, including expenses regarding personnel, material, equipment, and contingencies, if any. So every detail, about the coverage of expenditure should be given in the budget planning. Then comes risk management planning. We have to identify the potential areas of risk, evaluate their likelihood and impact on the project, and then develop strategies to mitigate this risk. That is called risk planning, risk management planning. Then comes communication planning. So the stakeholders are there who have their own expectations and they give specifications also. So all the stakeholders must be always willing to know what is going on in the organization about the project. Therefore, it is the duty of the organization to keep them always informed about the progress of the status of the project. So here the organization has to decide what communication channel is to be used, how frequently it should be communicated, what is the type of reporting structure. Everything is to be decided by the organization, and that is this communication plan. Then comes quality plan. As I told you already, the stakeholders will give their specification about the project. So then we have to establish quality standards and define clearly various procedures to assure the quality expected by the stakeholders. Not only for quality assurance we have to plan, but also for quality control also we have to create a plan. So these are the various key activities to be undertaken under this second stage. Now what is the outcome of this stage now? Once this stage is completed, a comprehensive project management plan is prepared, is ready. That will clearly define the scope, schedule, budget, and risk management. So clearly we have a plan for everything. Comprehensive project management plan is ready now. Now let us move on to the third stage, which is called execution stage. Execution. I think it is clear now. It is visible now. Execution stage. So this is a stage where the actual performance is carried out. actual work of the project is taking place. Resources are allocated, tasks are assigned to each and every person, and they are to be performed to create the project deliverables. So finally, we have to deliver certain thing to the client. It may be a product, or it may be a service, or it may be a report, whatever it is. To create such project deliverable, the task is to be performed. So it is a stage under which actual performance of the task takes place. What are the key activities under this stage? One is task execution, that is performing the defined task is called task execution. That is actual carrying out of the task and deliverables according to the project plan is called task execution. Then comes team coordination. For effective task execution, the team performance is to be managed carefully. We have to assign the task to a right person to the right task. We have to resolve the conflicts, if any, and ensure that entire team understands their roles and responsibilities very clearly. That is called team coordination. Once you understand your role clearly, then there will be no conflict. When there is no conflict, there will be effective coordination. Then comes resource management. That means all the resources, available resources, are efficiently or effectively used. In other words, optimum utilization of available resources to be ensured. Therefore, monitor resource utilization very carefully and make adjustment of allocation or reallocation if at all it is required. Then quality assurance. So ensure that the project deliverables meet the defined standards and requirements or specifications of the clients. Therefore, we ensure that we have to perform quality assurance and control checks are to be made to ensure that the project outputs meet the predefined quality standards of the clients or stakeholders. Then finally, we come to the stakeholder communication. Regularly update about the progress of the project to the stakeholders. Updation of the status of the project, about the progress of the project to the stakeholder is a must. Not only about progress, even about the issues, if any, are challenges met by the organization execution stage, or even changes made to the project should be communicated to the stakeholders regularly. So regular updation of the stakeholder is very, very, very critical for the success of the project. Then comes monitoring and controlling. So track the project, track the performance of the project against your plan. Ensure that your actual performance of the project goes in lines with the plan of action, including the cost, including the quality, including the time. Everything goes in lines with the your plan of action. That should be ensured. That is called monitoring. If not, immediately take corrective action. Then risk management. Continuously monitor the risk and their impact. Implement mitigation action if necessary. Then comes change management. If at all you want to make any changes regarding your any resource of the any element of the project, say for example, you want to change the time, or you want to change the cost, or you want to change the other relevant factors of the project, then you address any scope changes or new requirements that arise during the execution. We have to address that to the stakeholders. That will ensure that they are all approved and incorporated into the project plan. If at all some change is required, some new adjustments are to be made, that should be, approved by the higher level authorities. Therefore, inform the higher level authorities about the change, about the impact, all these things, and get the approval, and then incorporate in the project plan again. So we have to revise the project plans. Then what is the outcome of this stage? Completion of the project deliverable in alignment with the scope and quality as expected by the stakeholder is the outcome of this stage. Completion of the project deliverable, that is product, or it may be service, or it may be report, or it may be result. So completion of that in alignment with the, in accordance with the Define the scope and quality as expected by the stakeholder is the outcome of the project. Then fourth stage, monitoring and controlling stage. Monitoring and controlling stage. So this occurs concurrently with the execution stage. It is an ongoing phase. It occurs concurrently, simultaneously with the execution phase. While you are executing the various tasks of the project, simultaneously you have to monitor and control. What is this controlling? Actual performance is compared against the project baseline, and we have to ensure that the project stays on track. It is on track. That is to be ensured. For that, simultaneously you have to monitor. If at all some deviation, immediately you have to take the corrective action and see that it is again put in track, on track. So what are the key activities under this stage is track the project performance continuously, measure the project progress against the plans. So what is planned is to be carried out. You have to ensure that. So measure the actual against the plan by making use of some key performance in these KPIs. Then scope control, schedule control, cost control. What is control here? We have to ensure that the actual performance goes in lines with the planned actions. That is called control. In terms of scope, in terms of schedule, in terms of cost, in terms of risk. Then identify variances, if any. So you are going to compare the actual performance with that of planned performance. If at all there is any difference, the difference is known as variance. Identify the variance and find out the causes for the variances. If at all is possible, you have to take the corrective action immediately so that the issue will be resolved. And then quality assurance, conducting regular quality audit and evaluation of various processes will ensure quality standards are being met as per the expectations of the stakeholders. These are all the various key activities to be performed. What is the outcome of this stage? You will get updated performance reports. Under this stage, you will get updated performance reports. Then corrective actions are made immediately to keep the project on track. Then we have to document and manage all changes and adjustments made during the projects. These are the outcomes. The updated performance report can be obtained. Corrective actions are taken to keep the project on track, and documentation is done. Document and manage all the changes and adjustments made during the execution of the project. Then comes the final stage called closing stage. Closing stage. I think it is visible on the screen now. Closing stage. It is. What is the meaning of closing stage? Finalizing all activities. That is called closing stage. Finalizing all activities. Once all deliverables have been completed, whether it is project, product, whether it is report, whether it is result, whether it is service, if it is completed, the project enters the closing phase. It marks the completion of the project. It involves finalizing all activities of the project and formally closing the project to ensure that everything is wrapped up appropriately, nothing is omitted. That is called closing phase. The key activities under this stage is deliver the final products. That means ensuring that all deliverables are completed, tested, and handed over to the client. Final quality check. Before just delivering the final products, just check whether the quality standards are met. Then obtain the stakeholder sign off. That is, the project sponsor or the key stakeholder should approve the final deliverables. This often involves a final acceptance report. Get the final acceptance report from the client. Then release resources. All the resources which we have derived, drawn from various departments are to be sent back to their parent department. That is called releasing the resources. Documentation and knowledge transfer. Ensure that all project documentation, that is contracts, reports, everything is being finalized and archived. So what are the lessons learned from this? It may be positive or negative. All these lessons learned are to be documented, which may be used as a basis for the other project, next projects. Then transfer this knowledge to operational team if necessary. Whatever lessons learned are to be transferred to the operational team, regular teams. Then conduct post-project review. Hold a meeting and find out what are the lessons learned to identify where and what went well and where and what goes wrong, went wrong. So we have to find out the areas of improvement that will help you to enhance future project management practices. And finally, close the contract. Close the contract with suppliers and vendors. Ensure that all payments are met completely. What is the outcome of this? We get project closure final report summarizing the performance, results, and lessons learned. Formal acceptance is obtained from the client. Then we have to archive the project documents, store all the project documents and deliverables for future reference or audit. So this is the outcome of this stage. This is what an important part under this project life cycle. Shall I continue with the next topic now for a few minutes? With your permission,
Okay, sir.
some 5 to 10 minutes,
Okay, sir.
so that I can complete the second unit, so other units can be taken up in the next class. So when you
Continue,
come
sir.
for the next class, I request all of you to bring your study material, because in the next 2 units we have to work out some problems. I can make use of the problems given in your study material so that it will be easy for you to handle that. Okay. Let me now complete this another part of this project feasibility studies with your permission. What is it visible on the screen now?
Yes, sir.
Yes. Okay. Project feasibility study. It is an assessment regarding the viability of the project before it is fully implemented. So before taking up the project in full, in a complete shape, we have to make an assessment whether the project is viable or not. Viability means the probability, possibility of getting, that is called feasibility study. It helps to determine whether a project should be proceeded with and whether it is to be proceeded with or not. And it will also help you to identify the potential risk. It will also help you to outline the resource requirements. It is a comprehensive assessment that will help you to determine whether a proposed project is viable, whether it is realistic, whether it is worthwhile or not. So under this stage, what happens? It can be classified into different types. It is including opportunity studies, pre-feasibility study, functional or support studies. Now let me explain this opportunity study. I think it is there in the. It is part of this feasibility study. Okay, opportunity studies. It is an high-level assessment conducted to identify new business ideas, new business opportunities, or new project ideas. It will explore whether a particular opportunity aligns with the goals of the organization or not, whether it is aligning with the market demand or not, whether it is really potential for growth or not, that can be ascertained through opportunity study. We have two types of opportunity studies: general opportunity study and specific opportunity study. Let me say about general opportunity study. So this is based. These are called broad and exploratory in nature. General opportunity study focuses on identifying general market opportunities or business trends without delving into specific details. They may explore various potential sectors or various potential industries or various potential regions for expansion, or it may explore new product development also. Generally, what is the market trend? What are the various market opportunities available? What is the business trend that is being explored under this study? That is called general opportunity study. Then comes specific opportunity study. Let me give an example of general opportunity study now, so that you can easily understand that. A company may conduct a general opportunity study to explore the feasibility of entering into a new geographic market. Whether we can enter into a new geographic market or not, that can be easily identified through general this opportunity study. Or the company wants to launch a new product line. Whether we can launch a new product line or not, that can be easily identified through this exploring study. A company may also identify the potential for expanding its renewable energy. Now it wants to expand its renewable energy market. It wants to get into renewable energy market. Whether it is feasible or not, that can be identified through this study. Then comes specific opportunity study. That means this study investigates a particular opportunity in detail to evaluate the viability of a specific business idea or a specific business project or market segment, providing complete detail regarding technical, financial, and operational aspects of that opportunity. Suppose that a company wants to conduct a specific opportunity study to assess the feasibility of developing a new software application, or it wants to build a manufacturing facility in a specific location. A company wants to expand its manufacturing facility by building a factory and other facilities in a specific location. Whether it can be done or not, that can be identified through only specific opportunity study, not through general opportunity study. Then let me now explain about the pre-feasibility study also. Pre-feasibility study. It is a more detailed investigation which is focusing on determining whether the project idea is worth pursuing or not. It is the first stage of evaluation before proceeding to a full feasibility study. Feasibility study, if you want to take up, before that you have to take a pre-feasibility study. First stage of evaluation of full feasibility study, whether we can go for full feasibility study or not, that can be determined only through pre-feasibility study. The purpose here is to screen out ideas that are clearly not viable before committing significant resources to a more detailed analysis. So if at all some doubt is there regarding viability, before committing your resources to a more detailed analysis, it's better to have a pre-feasibility study and find out whether we can go for full study or not. That is called pre-feasibility study. The key elements of this pre-feasibility study is technical assessment, financial assessment, market feasibility, and operational feasibility. Technical assessment. It evaluates whether the technology or expertise and resource needed are available in the market or not. or even if it is available, whether it is feasible or not. That can be assessed through technical assessment. Financial assessment, it gives a rough estimate, cost estimate, revenue potential, and profitability of the project. So it gives a rough estimate of all these things. Then market feasibility, it looks into the demand position, competition position, market conditions, whether the project can succeed commercially or not. That can be ascertained through market feasibility. And finally, operational feasibility, assessing whether the project can be implemented with existing or attainable resources or capabilities is done through this stage. So these are the various, concepts to be undertaken or functions to be undertaken under pre-feasibility study. Then we have functional studies or support studies. About which also let me say something now. Functional studies, otherwise known as support studies. They focus on functional requirements of a product or service or process. What are the functional requirements? It may be purchase, it may be manufacturing, it may be finance. What are the various functions to be performed to get a product or to get a service or get a process? And it provides detailed information about how those functions will be achieved. So what are the key areas here is system requirements. That is identifying and documenting the functional and technical requirements needed for the project to succeed. That is called system requirement. Technology and resources required. What is the process to be followed? And then other support services like maintenance, training, customer support. About this, a detailed study will be made, that is called functional studies or support studies. So these are all important feasibility studies that is to be undertaken before investing your resource, investing money into resources, significant resources, so to ensure that whether the project can be successfully completed or not, whether the project is profitable or not, whether it is feasible to carry out or not. For this, these different studies are to be undertaken. So with that, I hope I can conclude this session. In the next session, let me take up the third unit, wherein we have to work out some problems also. So kindly, if possible, bring your study material so that it will be helpful for us to complete the process quickly. Is it
Thank you
okay?
very much, sir. Thank you, sir.
Thank you very much.
Thank you, sir.
Let me conclude the session now. Thank you very much.